Good morning, everyone. It's a 9 o'clock sharp, and we want to be very punctual. So welcome everyone to the fall outlook from the UCLA Anderson Forecast. So for those of you who do not know me, my name is Sebastian Edwards, and I'm the new faculty director of the forecast. It's a very challenging position because I am stepping on the shoes of great predecessors. I could go all the way back, but I want to recognize Dan Mitchell, who is here with us, and he was the director of the forecast quite some time ago. I'm not going to ask him how many years. And then the great Ed Leamer, my colleague and great friend, who recruited me to come to UCLA many years ago. I may be the active faculty member here at Anderson that has been here for the longest time. I don't look that old, but I am really old. So I've been here. If I look around, I've been here for longer than quite a few of you have been alive. So that tells you for how long I've been here. We have a great program. I've been given one of the tasks is to thank our sponsors. So I have to read a list. So bear with me, and after I read the list, I'm going to get into some more issues related to our conversation today. So we have several. The reason why we read these is that, on the one hand, to thank the sponsors. On the other hand, to encourage those who are not sponsors yet to become sponsors. And we have several categories, so also to encourage those who are at a certain category to go to a higher category, okay? So principal level, RSM, Yamava Resort and Casino at San Manuel. Platinum level, the law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Mercury Insurance, and the University Credit Union. Gold level, Alaska Airlines, a Bank of California. I love that, bank with a C rather than a K. California Steel Industries, Hub International, Leap Development, Numo, PNC Bank, Robert Half, SMBC Manu Bank. Silver level, Slalom, US Bank Private Wealth Management, Wilmington Trust, and bronze level, Accutive Security, Anmi Bank, lots of banks, huh? That's good. HDR, the Port of Long Beach. We're going to be talking about tariffs and trade and logistics today, and Shomat Design and Construction. So those are our sponsors. If your company has not been named, it means that you are not a sponsor. What about that? It's a good conclusion in a business school. That's the kind of things that we teach here. So do become a sponsor. That would be great, and would help us continue with this work that we do every year. So today it's the fall outlook, and it is a very interesting time that we are living. We have presentations from Clement Bohr, our senior economist, who's going to talk about the U.S. economy. We have a special guest speaker on logistics and maritime trade, Geraldine Natz. We thank her for coming. And then we have two panels, one on income, on the environment, and one on trade. I forgot to mention, because it's in the same session, Thomas Hash, our economist, who's going to talk about the California forecast. Okay, so I don't want to steal Clement's thunder, but since I get to speak first, and I am sort of the boss, although we don't have bosses here at the universities, I'm going to steal his thunder. He's going to tell us that there will be no recession. But he came to that conclusion before the government was shut down a few hours ago, right? So I'm going to ask him, I'm sure that he has thought about this. We had our seminar, our preliminary seminar yesterday, but we didn't know if it was going to shut down, but it looked pretty bad. So one question that in the next 3 minutes, Clement, you can think about the answer. After how long would the probability of a recession increase? Okay, so now the government has been shut for 9 plus 3 for 12 hours, right? So because it shut down at midnight. So I think the longest, it's been 35 days or 37 days. So there is going to be a certain like tipping point or the where I mean, if it's 7 years, of course, we're done, right? So is there a length where we think, oh, now it's getting really dicey, so that's a question. Other news that is very important that comes from today. The Supreme Court just had a ruling saying that Lisa Cook, the member of the Board of Governors of the Fed, can stay in her post until oral arguments are presented to whatever court in January. Okay? So that means that the board, at least until January, and this is very important because it sets interest rates. And interest rates, of course, determine the cost of capital. The cost of capital that affects the WACC. And if you went to business school, and even if you didn't go to business school, the WACC is very important because it's the weighted average cost of capital, and it determines and defines whether investment projects in your company are worthwhile undertaking or not. Okay? So there is a whole issue about the governance of the Fed, the independence of the Fed, what may happen going forward. And one of that, if you've been following the news, an important component of that debate is the fact that the White House would like Lisa, who is a good friend of mine, I've known her for a long time, whether she should be dismissed from her position. We have a new member, Steve Myron, at the board. That seat, if you've taken my classes, you know that Fed governors are appointed for 14 years, although the 14-year length is for the seat, not for the person, so you can get into an unfinished term. So Steve is, he replaced Adriana Kugler, and that seat expires in January, so there has to be an appointment. Then Jay Powell's chairmanship expires in May. We don't know if he will stay on the board or not. Usually, chairs, when their term is up, they resign from the board itself. I checked how much those people make, not a lot, so we don't know. But a key question is what will happen to the Fed and interest rates and the cost of capital. And that, of course, is related to everything, right? Including the dollar and other issues. Migration, it's a big question. The environment, trade. I have 1 minute and 20 seconds left. On migration, just to tell you, I was a member. I was honored to be appointed a member of the Council of Economic Advisors to Governor Schwarzenegger when Arnold was the governor. And at that time, there was a bill that almost made it being discussed on immigration. It was the McCain-Kennedy bill. John McCain, senator from Arizona, and Teddy Kennedy, senator from Massachusetts. And Arnold asked me to do a study on what it would mean for California if all undocumented workers were deported. Okay? And we did that study. That was a very interesting council. It was chaired by George Shultz, the former Secretary of State, and among its members, it had Milton Friedman. And we did that study. So California, migration, the economic consequences of massive deportation and so on, it's something that we have been looking at for a very, very long period of time. So with 13 seconds to go, once again, I welcome you, and I want to introduce my colleague, and he's beginning to be a friend of mine slowly because he's only been here in town for, a month now, 2 months? For 1 month. So Clement Bohr, who's going to start talking to us about the U.S. outlooks. Thank you, Clement, and welcome. That's what happens when I leave the podium.
Thank you so much for that. Everything okay now? Okay. So it wasn't Sebastian, it was me, and thank you very much for that introduction, Sebastian. What I'll be walking through with you today is a series of inflection points that happened to the U.S. economy this summer that really sets or shows you the new trend the U.S. economy is going on. But as you know, so far, at least in 2025, it's been a pretty wild ride, and there's been a lot of different themes and topics. You know, we've had a stock market crash, we had Doge, we have had talk about stable coins. And so it's hard to figure out and really narrow your perspective to see what's really mattered so far in this economy. And so I want to start out with the three elephants in the room, at least to date in 2025, that really have mattered for the aggregate US economy. This could still, okay, I'm just going to walk over here. This could still change. As Sebastian mentioned, we're about to go into a government shutdown. And I'll talk a bit more about that at the end, so I have a little more time to think about Sebastian's question. But perhaps, by the winter quarter at the next conference, I'll be talking much more about that topic if we didn't get out of this shutdown relatively quickly. But to focus on the three elephants I have in this picture here, of course, we have tariffs on the right. That's been the main theme from the very beginning of this year, when it became clear that the new administration was imposing tariffs at levels we hadn't seen since the early 1900s, and they were also among the worst case or most extreme scenarios that we expected before the administration was coming in. And they were so high and are so high that many were worried that the tariffs just alone, whether they could lead to a recession or not. Then as we moved on through the spring, it became very clear that artificial intelligence, and especially the investment expenditures into artificial intelligence by the big tech firms, was really lifting up and giving a lot of boost to the economy, because these big tech firms, again, were just putting so much money into the economy and creating a lot of GDP growth. And so these are a lot of different forces that are happening at the same time. Maybe the AI is actually a bubble. And so you have the Federal Reserve mentioned as the FOMC in the picture in the background, looking very nervous, trying to figure out how to handle these juxtaposing forces in the economy when it can only really have this one policy lever of interest rates to sort of attune the temperature in the room, right? And at the same time, they have the administration and, forcing or not forcing, but would like to lower the interest rates on their behalf. So turning to the inflection points I want to talk to you guys about, the first one is that over the summer, we are no longer trending towards our 2% inflation target. We are now trending upwards. And as of August, the core CPI is now going at 3.1% inflation over the last year. Okay, so we are going in the wrong direction. That was not a surprise. We were expecting tariffs to be passed through into prices and raise inflation, and we're expecting that to happen over the summer. But what has been more surprising is the fact that a lot of the inflation so far has actually been coming from the services sector. This is not shelter, but the core services of healthcare. We've seen the cost of dental care services go up, airline airfare costs go up. So sectors we weren't expecting a lot of inflationary pressure have actually been lifting up inflation so far. And the question is whether that's also a shift in trend or whether that's just a momentary blip. On the other hand, that also means that, and we can see this from survey data, a lot of the costs from tariffs still haven't been pushed through into consumer prices. Majority of it is still being eaten by the companies that are taking a hit to their profit margins or had hopefully imported a lot of inventories before the tariffs came in and are running those inventories down. And so that means a lot of those prices are likely still going to rise because of tariffs. And one way to see at least some of this pressure is already baked in the cake is to look at the figure I'm showing you here on the right, which shows the level of inflation throughout the goods supply chain in the US economy, where stage one you can think of as very crude raw materials and commodities, all the way to, say, stage 2 or stage 3, which are intermediate inputs, to then goes into stage 4, and the final demand, which is the final good that the wholesale and retailer actually buy it in to sell you. And what you see is that as of this summer, now all the intermediate stages before final demand now have a higher inflation rate than the final demand. And when that happens, these prices and these in the earlier stage of production are eventually going to spill into the later stages of production and raise that final demand. So you can see here, though it's only a smidgen right now, the trend is that this is going to be pulling final demand more and more up in terms of its inflation rate there. The next inflection point is the labor market. So most of 2025 going into the summer, the labor market was still looking fairly strong and robust, but now there are warning signs that are flashing yellow in terms of the health of the labor market. For instance, we've had payroll growth go to near zero over the summer on a month-by-month basis. In fact, in June, we had negative payroll employment growth. And at the same time, the payroll growth we do have in employment is coming from a very narrow subset of sectors, such as healthcare and education. The majority of the US sectors in the US economy are actually shredding jobs right now. The unemployment rate is still low, but as you see in this right figure, it is rising and is now going to 4.3%. And the other thing that this picture points out is the jobs vacancy rate. And so that's the number of postings, the amount of jobs that are out there that are looking for people to fill those jobs. And what you see is that this is another inflection point in the sense that there are now more people looking for jobs out there than there are jobs available. So right now, this is not a worrying sign. They're about even, and that's considered a healthy economy, but it's again the trajectory and this pivot where we're now going from a very hot, strong labor market to one that's a cold labor market. On the other hand, as I said, it's only flashing yellow. There are still very good signs that the economy and the labor market is holding up very well. The initial unemployment claims are very low, meaning that not a lot of people are getting fired and asking for unemployment. And layoffs and quits are also very low. So that's why, and you may have heard it before, that this economy right now is considered a low hire, low fire economy, essentially paralyzed, where companies are hunkering down throughout this uncertainty and the labor market is gradually degrading. And one way you can see that is that if you don't have many people being hired, well, the majority of people who are being hired are the young people, right? And there, the unemployment rate has actually just reached up to double digits. It's at about 10.8% right now. And so that's a real concern to see that the next generation of people aren't able to get smoothed into the job market right now. And with inflation rising and unemployment rising, that puts the Federal Reserve and the interest rate setting in a very difficult position because they imply different directions for where to set the interest rate. When you have unemployment go up, I can describe this through the figure I have here that's called the Taylor Rule. The Taylor Rule is a very simple prescription and a good way to think about where to set appropriate interest rates. And so it's set by a neutral rate, which is the rate at which you'd expect the economy to be in balance, where there is no accommodative or restrictive pressures from interest rates on the economy. And then there is an adjustment for inflation and unemployment, where the higher the inflation, you want to set higher interest rates to bring down that inflation. And the higher the unemployment, you want to lower interest rates to boost the economy and lower the unemployment rate. And so a hawkish rule is a rule where people care more about the inflation mandate. Okay? So if you have higher inflation, you care much more about that and want to raise interest rates more. And so that's why you have this yellow region above gray region, signaling that if you're a hawkish person, you'd want to set higher interest rates in that area. On the other hand, you also have dovish monetary policy rules and monetary doves, which are people who care much more about the labor market. They care about the fact that the unemployment rate's rising. That's a much larger concern. And so they're going to want to lower interest rates to help keep that labor market afloat. And what you see over the last couple of months is that that region in both areas is just expanding. So this is really a lose-lose situation for the Fed. Are they going to raise or lower interest rates? Well, we've already know what they've done. They've decided to cut interest rates. And so that's what you see in the black line going down and actually going into the blue area being a monetary policy dove. And they've explicitly announced this. They say that the weighting of the risks has shifted over to the labor market, and they care more, or not more, but they care more than they did before about the labor market relative to the elevated inflation rates, right? And so Powell, the chairman of the Federal Reserve, was also call this a risk management cut because there is so much uncertainty out there. And so they're saying, well, just to make sure the labor market doesn't bottom out and we don't have a recession, let's just cut interest rates a little bit now. And then we can, once more data comes in, then we can reassess. There's a little asterisk there now because with the government shutdown, we might not have any more government data coming in about the economic statistics. So hopefully the shutdown for the Federal Reserve's sakes doesn't last too long on that part. There's also another concern with this risk management cut is that it also has to do with lowering the temperature that for the Federal Reserve that's coming from the administration on the political side that's pushing them to lower interest rates. The hope is that if they just cut interest rates a little bit, that'll again take off some of the heat from the administration and give them more time to figure out where the economy is heading. And one signal that may be happening is if you look at the changes in the Federal Reserve's own projections of how the economy is doing between their July meeting and the September meeting. And in between that time is when we really saw the labor market weakening, right? But in their projections of where they see the economy's going, they actually don't see as much a deterioration in the labor market as they did in July. And they also see more inflation in their projections than what they did in July, which would mean the exact opposite of what you'd want to do than lower interest rates. So some people pointed out that it's very weird with that change in projections that they would actually lower interest rates rather than keep them steady for longer or even raise them. A lot of people are calling, and as you can see in this plot, is also could be argued for even raising interest rates. And lastly, before I go to our forecast, I also have to talk a bit more about artificial intelligence. I already mentioned how much investment expenditures have been boosting this US economy, and that's what I'm showing you in this graph on the right-hand side. What I'm showing you is not all of GDP growth. I'm showing you core GDP growth, which makes up the most of it and strips out the volatile components of net exports and inventories. The reason why we strip those out for now is because those have been very volatile this year. And so it kind of obscures the image of how well the US economy is doing. And the core GDP measure shows a much better image of that. And what you see is that throughout 2023 and 2024 in the black line, which is core GDP in total, it's running at around 3%. And through 2025, that's now lowered to about 2%. Now, 2% GDP growth is still pretty good, but it is a weakening from what we've seen before, right? The more concerning part is if you look at the components that make up GDP growth, which are the blue in consumption, the yellow in investment, and the gray in federal and government expenditures. And what you see is that in 2025, the blue consumption bars have become much smaller, all right? On the other hand, we had these huge yellow bars from AI-related investment expenditures. So without this huge surge in big tech investment in AI, GDP growth this year would look very, very weak. And so the question is, of course, well, can this be sustained going forward? If you ask the big tech firms, yes, it can. They have projections that their investment expenditures in artificial intelligence are going to double. They're going at around 250 billion right now, which is huge, and they're going to go to 500 billion by 2028. All right. But those projections rely on the expectations of revenue growth for artificial intelligence. That's around 50 billion across all these companies right now. And they're going to go to 1 trillion by 2028. So incredibly optimistic expectations for how fast we're going to see profits and revenues from artificial intelligence related activities. And that's what's really driving this, right? And so if we don't see that realized, you should not expect these projections to necessarily sustain themselves. So that takes us to the US economy and our outlook for the economy. Our first expectation is that unemployment will rise. We expect it to go to 4.6% by the beginning of 2026. This comes mainly on the tariff policy, which is going to weaken demand, but it also comes from immigration policy and the economic policy uncertainty that we still have going out the economy. In fact, you may have seen measures that economic policy uncertainty peaked back in April and are lower now. I think if you ask many economists, they don't feel that way. I think because we've just seen all these inflection points in the economic data where the economy is actually going, and whether is it going to weaken further, is it going to be recession, or is it actually just going to plow right on through in part because of artificial intelligence. Right now, I've never felt more uncertain about the trajectory of the US economy because we really are at an inflection point or just past an inflection point. And lastly, we do expect a recovery in 2026. Going into 2027, because we do have a lot of monetary and fiscal stimulus coming. We already saw the first rate cut in September from the rate cutting cycle of the Federal Reserve, and that's already lowered long-term interest rates a bit. But the new thing that happened over the summer is the One Big Beautiful Bill Act, which is going to induce fiscal stimulus into 2026 and 2027. And the main reason for that is that even though a lot of these tax cuts are just extensions of past tax cuts, so that's not really a change in new policy, there are new tax cuts and there are new spending cuts. But the tax cuts arrive next year in 2026. And the spending cuts to green energy investments and Medicaid and SNAP and so on, they don't come into effect until 2027. Right? So we're going to have this front ending of the stimulus before the cuts come in. And then lastly, another reason why unemployment may not recover very strongly and be slightly elevated is if artificial intelligence enables firms to cut back on its workforce, right? So there's already a lot of discussion about this in terms of right now, but right now there's not very robust data that is happening. There is suggested evidence that there is a higher level of unemployment, especially among the youth, because of artificial intelligence, but it could also just be confounded with a lot of other trends and variables that are going on. However, this is top of mind and it could change going forward with more jobs actually being displaced by artificial intelligence. Turning to inflation, we do expect inflation to continue to rise. As we said, we haven't seen a lot of the pass-through of tariffs into costs, the price of goods yet. We also have a weaker dollar that's about 10% weaker than the beginning of the year, which is also going to make imports more expensive. And as I mentioned, there's also core services. These services inflation are not cooling anymore. And so the question is whether they're going to keep rising or whether they're going to stay just slightly elevated. Where our outlook has really changed here is on the long end in 2027. So here we no longer expect inflation to get back to 2% target in 2027. And why is that? Well, it's because of this new stimulus we're getting in both from the fiscal and monetary policy side, but it's also because of inflation expectations. Okay? We're almost at the 5-year mark or coming up on the 5-year mark where inflation has been above target. Okay? And now inflation is not getting close to target, it's actually getting further away. And at the same time, the Federal Reserve is cutting interest rates, making it even less likely that we're going to get back to target in the future or anytime near future, right? So inflation expectations can only stay, anchored at the target if people actually expect inflation to reach the target eventually. And the longer the time we're spending away from the target, the more we should expect inflation anchors to slightly unanchor these inflation expectations, right? And the attacks by the political administration on the credibility of the Federal Reserve is also undermining those inflation expectations. We also the yield curve to widen. This is not surprising, and normalization. Usually, the yield curve is not as flat right now, so we expect there to be this widening difference between the long-term interest rates and the short-term interest rates. We had a cut in the federal funds rate in September. We expect another one in October, but after that, with rising inflation, we do expect them to pause in December and January, and then continue the rate cutting cycle next year, then to get down to the 3 to 3.25% interest rate. We do not see much more downward pressure on the long end. We have seen a little bit recently, but now those future interest rate cuts are already baked into the long-term interest rates. And so to make that fall much further, we really need a recession or a much further deterioration in US markets to see that drop more significantly. And at the same time, we have a lot of upward pressure on long-term interest rates from the increasing US debt that needs to be funded, which is going to make it more costly to fund that, as well as the elevated inflation expectations, which I just mentioned to you earlier. And so we see that rising. It's around 4.1, 4.2% right now to get up to 4.4% by 2027. And Sebastian already spoiled it, but we do not predict a recession is going to be happening, but we do expect a weakening in GDP growth for the same reasons that I mentioned related to unemployment. And we also expect a strong recovery in 2026 for all the reasons I mentioned related to unemployment. But the new points I do want to mention here is, first of all, this AI boom, right? And whether it is a boom or whether it's a bubble, and whether if it is a bubble, if it's going to bust, right? We cannot predict a bubble after it has popped. And if it is a bubble, you also cannot predict when it does pop, if it does. So even if it is a bubble, we could have this financial exuberance going on for years, all right? Or it could pop tomorrow, right? There's also the chance that it is really it is a transformative technology, but transformative technologies historically have also always been associated with financial exuberance and unanchored financial markets. And so there is often a correction in financial markets, even with transformative technologies as well. Great. The last thing I should note here too is that the GDP forecast, you should take it really with a grain of salt right now because, again, the volatile components of GDP, which is net exports and inventories, are very large right now, which is creating a lot of variation in the quarter-to-quarter GDP numbers. And so we want to go home and look at GDP numbers. I again encourage you to look at measures that take out the very volatile components. And I mentioned to you core GDP. Another terminology for that is real final sales to domestic consumers or private consumers. There's a bunch of good measures out there that kind of try and take out all this noise. So to conclude, inflation and unemployment are rising, and we expect them to rise modestly more, but not excessively so. And there are huge risks to the forecast. So we just entered a government shutdown today. Usually government shutdowns are short, and government shutdowns that are even in medium-term lengths are not that damaging to the macroeconomy. So a rule of thumb estimate is that for every week that there is a government shutdown, there's a 0.1 percentage point decrease in GDP for that quarter. But a lot of that is then made up in the following quarter, where those payments to the workers that have been furloughed are backfiled. But we are in unprecedented times. Maybe this shutdown will go on for a very long time because the political situation is different. And there's also been threats on the administration that maybe they'll use this opportunity to fire a lot more government workers, and that could also change this situation, right? If we already have a labor market that's weakening, and now the government decides to lay off a lot of workers, maybe that's the final, or maybe that'll set off over the edge to into a recession. But at least on my end, I doubt that that'll be the scenario that happens. But it certainly is a risk to the forecast. We also have another Supreme Court ruling that's coming up related to tariffs. So Sebastian didn't mention this one. He mentioned the one related to Lisa Cook. But on tariffs, most of them so far have been implemented under this International Emergency Economic Powers Act. And if that's overruled, all those tariff revenues have to be reimbursed, which is going to be a nightmare. But if they are reimbursed, that could be hundreds of billions of dollars in a one-time stimulus measure to the U.S. economy. And it's also going to mean that these tariffs are going to go away. Now, they're only going to temporarily probably go away because the administration has a lot of other trade acts it can use to enforce tariffs. It's going to be a lot messier and a lot more annoying for them to implement, which is why they went with this act. But you should not expect tariffs to go away if this trade act is overruled. Sebastian already mentioned a lot about Federal Reserve independence, so I won't go more into that. And I already talked a lot about artificial intelligence, so I'll end there. Thank you.
Okay, is this working? Seems good. Thanks for that, Clement. I think we'll all agree that it's a fascinating presentation about pretty fascinating economic times from an academic point of view, at least. So I'm just going to switch gears a little bit and talk about the California-specific economic outlook. And so here we've titled this Employment Recession Worries. So we'll kind of get into that a little bit further down the line. But first of all, I just wanted to start with some kind of context specifically about some of the California state legislature's bills that have been passed and announced over the past month or so. So just bear with me just for a second, but it turns out that there's kind of an interesting etymology for this term gerrymander. So back in 1812, Ellsberg Gerry was the Massachusetts state's governor. And at that time, he became a little bit concerned that his party might lose out in the Massachusetts State Senate. So as a result, he did this thing that we're kind of more familiar with these days, which is he drew some of these sort of interesting looking districts. And people at the time were a bit incensed about this. And so some people noted that this district in particular looked a bit like a salamander. And so the Boston Gazette published this cartoon at the time, and you can see that someone had drawn on the claws of the salamander there and a face as well. And they even added some wings. And people started calling this the gerrymander instead of the salamander. So, why am I mentioning this? Of course, Proposition 50 is this special election that's been put on the slate for around the beginning of November. And so this is part of these kind of ongoing redistricting battles in the US at the moment. And so here at the Forecast, we're not political analysts as such, but it might be interesting to think a bit about the economic implications of these elections, right? So it turns out there is some interesting academic evidence on this. So in particular, this first one on uncertainty. So there's a professor, her name is Candice Jens at Tulane University, and she published this interesting study in the Journal of Financial Economics. And basically there, she showed that in the run-up to elections, there's often this period of uncertainty, and that leads firms to put off some of their hiring decisions and also some of their investment decisions until after the election has taken place. So that seems like an important effect. So then we want to think about whether this applies to this particular election. So in the case of that paper, she's looking at gubernatorial elections, which tend to be a bit more directly affecting economic policy. This election is a little bit less clear in terms of its direct economic implications. And so we might think that this election is less key for this kind of effect. So we don't think this effect to be particularly important for this election. So another element that we might think about is government spending. And so there's quite a lot of money that goes into administering these elections, and that provides a bit of a boost to the state potentially. So there's a whole bunch of employees that have to do things like print ballot papers and various other things. And in addition, the campaigns themselves spend quite a bit of money on different aspects related to running these campaigns. So that could provide a bit of a stimulus. And so there, to get a grip on some of the magnitudes that might be involved, we might want to look at other special elections that took place. So the most recent one of those was 2021, when there was a recall election for Governor Newsom. And so there, the state spent around $250 million, right? So say if we double that to just account for the possibility of campaign spending and the impact there, then that comes to around $500 million. And so, it's a big sum of money, but compared to the roughly $4 trillion of California's state GDP, it's a bit of a drop in the bucket. So we don't necessarily expect this election to cause too much of an economic stimulus and have too much of an economic impact, even though obviously its political implications might be more important. So this, as I mentioned, this is just one of a series of bills that were passed this month, actually, in the California state legislature. So September is the time in the legislative calendar where the state legislature has to pass its bills before they're kind of thrown out if they don't reach a vote. And so another one that might be interesting to think about is the cap and trade program in California. And so what I'm just showing here is California's emissions in million metric tons of greenhouse gases emitted. And so what you can kind of see here, the black line just shows the actual emissions, and the dashed line shows the kind of trend to these targets. And you can see that California did pretty well in the first target of 2020. It was reached a number of years early, but it looks pretty steep to get down to that 2030 target and the 2045 target, right? So a part of this is this bill that reauthorized the cap and trade program. It reauthorized it out to 2045. Before that, it was only authorized till 2030. And so this is an important part of creating more certainty for this program. So in the past year or so, the prices on these polluting permits had been trending down a bit as companies started to doubt that these permits would still be in place going further out into the future. So this creates an important amount of certainty for businesses. Another element of it was that it was renamed the Cap and Invest program to give it a slightly more pro-growth title and a little bit of a makeover, perhaps. And in addition, it outlined some spending commitments for the proceeds of these permit auctions. So that's kind of an important clarification. And so here again, thinking about the economic implications, although this is important in terms of its sectoral level economic effects, it's mostly a reallocation across sectors. So reallocation from sectors that pollute more to sectors that are more green and that are more the focus of this program. And so because it's a reallocation, we don't necessarily expect there to be big economic effects from this either, okay? So those two a bit of positive, contribution to the state economic outlook, but not so much. So what about all the other bills? So just to summarize some of the rest of them, as I mentioned, there's this cap and invest renewal. There was also a bunch of other energy bills that were focused on kind of growing the energy sector, various ones along those lines. There's also these bills aimed at CEQA streamlining. So this is the California Environmental Quality Act. And so there, people had noted that that bill had been getting in the way of growth and building to some extent. So there's been some bills aimed at reducing that. And then there's some additional ones that might be mildly stimulative, like this film and TV tax credits bill. But in each of these cases, there are kind of obstacles to these bills providing substantial economic stimulus, right? So in the first case, these bills, as I mentioned before, they're relatively small overall. And in the case of the cap and invest program, it's more of a reallocation. And then in the case of these CEQA streamlining bills, this is potentially hindered by the weak construction sector at the moment. And so I'll go into what I mean by weak construction sector, but that's something that we think is going to be an obstacle there. And then a third problem is the California state's deficit position. So what you can see here is a chart from the Legislative Analyst's Office predictions of California's deficit over the next few years. California is mandated to balance its budget every few years, so it has to outline spending reductions if there's projected to be a deficit. And as a result, there are a bunch of spending reductions in line, particularly for Medi-Cal and various other programs. And so these, we think, will probably offset any of the expansionary effects of some of these other bills, because this will be mildly contractionary. So overall, we don't expect these bills to contribute substantially to economic performance. And then what about the construction sector? As I just mentioned, well, here I'm just plotting the number of construction jobs. This is payroll jobs from 2001 onwards. And you can see there have been various ups and downs, in particular in the run-up to the financial crisis. There was this run-up in construction sector jobs before it dropped off a lot. Following the COVID pandemic and recession there, you can see that the jobs picked back up and then sort of normalized for a while before sort of dropping off, right? And so this partly has happened as a result of higher interest rates, meaning weak demand in the house building sector. But also now there are several headwinds like deportations. So a big part of the construction workforce, especially in California, is undocumented immigrants. And in addition to that, the construction sector is very dependent on imports from abroad. So when you think about things like gypsum and timber, these are all things that are now going to be subject to tariffs, and so that creates another headwind for the construction sector. So we're expecting this to continue this kind of weak trend, and that will continue creating obstacles for these attempts to boost development in California. And this is just a chart showing you California versus the US, construction jobs as a percentage of total employment, and that just underscores roughly the same conclusion. Okay. So just to summarize this sort of overall context, this is real GDP Q-on-Q growth. So this is this important measure of the total amount of output for the state. And I've got here California, which is the blue line. I've got the US, which Clement talked about a lot, in the black line. And then in addition to that, I've also put Texas on here as another similarly large state, just as a comparison. And what I think is really interesting about this chart is looking in the kind of 2010 period, you see that California was kind of consistently outperforming the US and Texas as well. And so that period is something I'm going to come back to a little bit more later. But more recently, California has kind of dropped off. In this period around 2020, which I'm labeling here this post-pandemic slow, you can see California went into negative territory for several quarters. And so there's no official recession definition at the state level. It's a country level concept. But looking at this data is what some commentators online have noted could be a recession if there was indeed such a thing at the state level. So there was several periods of weakness. But more recently, California has kind of jumped back up and sort of been performing alongside the US economy. But you can see this really starting to dip off in the same way that growth for the US economy has. And so it seems to be this kind of slowing economy. Okay. So just moving on to employment then. So in the California context, the employment data is particularly important. And so the reason is because the other data that I just showed you comes out with quite a lag. It doesn't come out in a very timely manner. And so in particular, the US GDP data for Q2 is on its third estimate already, its third revision, whereas the California GDP estimate for Q2 only came out last Friday. So it's probably going to go through several rounds of revisions. It's not very contemporaneous. Whereas the employment data also has issues, obviously, but it is a little bit, it's a bit more timely and it comes out more regularly. So we're interested in the employment outlook. And I think this chart is really interesting for that same reason before, because we can see during the 2010s, there's this really nice thick period of employment growth. So this chart is showing payroll jobs additions or losses. So that's essentially if you take the total number of jobs in any given month, and then you subtract the previous month's employment total from that. So it's the total number of job gains or losses in any month. And so you can see this very thick period of strong growth in the 2010 periods. But if you look at this more recent period, you can see this is really starting to drop off. There are some positive periods, but it's a bit more inconsistent, and there's more negatives. So if we really kind of zoom in on this more recent period, then you can see that in 5 of the past 8 months, there have been reductions in jobs. And those months where it's increased have not been enough to offset those months where there's reductions. And so cumulatively, if you look at this since the beginning of 2025, California has shed 21,000 jobs, right? So it's definitely a very weak picture. And my colleague, Jerry Nicholsberg, is very insistent that there will be probably downward revisions to these numbers, so they may be weaker next time we look at these, right? So this is a weakness and an outlook that we expect to continue for several more quarters going into the early part of next year, and before picking up in late 2026 and into 2027. So let's just look a little bit into more detail of what underlines these stats to try and see what's going on here a little bit more. So a key subsector when we're talking about this is tech, and this is kind of a key part of the story here. So with tech sector, there's no specific NAICS category for it, so we have to piece it together based on a couple of different categories. So here I'm showing professional and scientific and technical services, and also computer tech. So these are the best kind of subsector classifications that we have for California. And so what you can see there, again, is this period during the 2010s where there's this really robust growth in jobs in California for the tech sector. And so this is really the bit that powered that employment gains, that very thick period of strong gains during the 2010s. But if you look at the more recent periods, you can see that since around 2022, 2023, there's these kind of tech sector layoffs that we've all heard a lot about. There's these sort of cost reductions that a lot of these firms started to employ, and the number of jobs started to fall off. It initially seemed to kind of stabilize, but then more recently, it's actually continued a bit of a downward trajectory. And so this in particular is a source of some of the weakness that we can see in some of those other charts. So, what do we expect to happen here for the future? Well, as I said, we're expecting California's employment growth as a whole to remain weak for the next few quarters. And a big part of this is tech, where we expect it to continue being weak for the next few quarters. And it's going to take a bit of time for this to start going back onto that upward trajectory, but we're expecting that to happen in late 2026, early 2027, as California returns to stronger growth. But it's worth noting that there is quite a bit of uncertainty here. A big part of this story is AI. Okay, here we go. Is AI. So this is the thing that we expect to really be powering that growth in tech sector jobs out into 2027. But there's a lot of uncertainty here, right? So we hear a lot of things about AI and its potential to really boost growth in the economy, but it's really not that clear, and there's a lot of uncertainty about how that will materialize, how long it might take. For a lot of historic technological advances, it's taken some time. Nick Bloom, who's a professor at Stanford, has a series of papers that mention that you should not confuse invention with adoption. And so the process of companies adopting AI as a technology is likely to take a lot longer, and it's going to involve a lot of kind of chance events that force companies to adopt different software practices and change their software architecture. So there is some uncertainty here. We think that we have kind of a moderate outlook, like kind of modest growth coming from the tech sector, Some people have much more optimistic views, and some people have much more pessimistic views. So there's some uncertainty here. So what about other important sectors here? So manufacturing has been an important sector that's contributed to some of the weakness over the past few quarters. And what this does is it breaks manufacturing down into a bunch of subsectors, so we can see where these losses are specified. And so here we've got a bunch, and what you can see here is that really across the board, across a whole range of different product categories, there's weakness in manufacturing. So transportation equipment looks particularly weak, but even across the board, if you look at beverages and tobacco, plastics, they've all been posting job losses. So manufacturing has been weak across the board. And this is something that we expect to continue being weak for the next few quarters, again, before picking up. This is not one that we expect to be a strong positive contributor to positive employment growth, but we do expect it to return to a more neutral level compared to these lower levels you see here. And so just to give you a final sense of where this kind of weakness is coming from and where these 21,000 job losses have kind of been concentrated, this is not comprehensive, so it's not all regions in California or all sectors, but it shows you where some of the most significant reductions are. And so this is like the San Joaquin Valley, Sacramento Delta area, Inland Empire, et cetera. And so some of the things you can see from this is construction and mining has been weak, especially in the Inland Empire. And business services has been weak, including in Northern California and Silicon Valley and others. And then one of the biggest contributors has been this state and local spending. So this is like local government spending, the kind of stuff that I was talking about at the beginning of this presentation, right? And so there, as I mentioned, we're not expecting there to be strong stimulus coming from state and local expenditure. And so that big increase that you see there, which has really been holding up employment growth in California, is not something we expect to continue. So again, it's a little bit of a bleak picture for California for at least the next couple of quarters. And so this is just kind of our outlook for the unemployment rate. California's unemployment rate, generally speaking, is usually a bit more than the US unemployment rate for various structural reasons. It's been trending up in the last few months and few quarters. You can see it's sitting at around 5.5% right now in the data. We're expecting that to kind of pick up and peak out at around 6.2%, which is not a devastating unemployment rate when you look at the historical series, but it is still higher than it is today, and it's still problematic. But then we're expecting that to fall down, and as I mentioned, a lot of that is predicated on this tech sector growth going into 2027. Yeah. So then just a quick review of the housing market too as being kind of a crucial sector that's important to look in for California. So here, what you've seen since interest rates went up in around 2022, 2023, existing single-family home sales have been very low, so there's been very few sales, but prices have remained very high. You can see there's some weakness in more recent months, but generally speaking, prices are kind of higher than ever. And so this is exactly the kind of environment where you would expect there to be a bit of a building boom. High prices, low home sales, we'd expect a building boom. But that's really not what we've seen. And so this here is plotting residential permits over the past sort of 15 years or so. And it's split into Northern California in the bottom and Southern California at the top. And I put these little trend lines in the black dash line. And what you can see in both cases, there's been a lot of weakness recently. And certainly there's not strong growth that we would expect from the other fundamentals in the housing, the housing data. And so, what's going on here? Well, some of it is this uncertainty about costs. As I mentioned, inputs into the construction sector are imported a lot, so tariffs plays a role there. Also these high interest rates that I mentioned before, but also labor shortages. And so as I mentioned, construction sector weakness is going to be something that continues to keep other efforts to increase development in the state down. So this is not something we're expecting to change immediately, and this is going to reinforce that weakness in the next few quarters. Okay, so just to summarize then, well, I guess not. Well, so to summarize, as I said, in the rest of this year and going into early next, we're expecting this kind of weak picture before tech sector growth, as well as some of the others, drive growth going forward. And 2027, we're expecting a return to kind of more superior growth as the state recovers. Okay, great. We're gonna do that.
Is this on? Okay, so we have a couple minutes for a few questions. We always like to take a few questions before we move on to our special speaker for the day. So, yeah.
Thank you. There's a drop in employment in semiconductors, but I know there have been some major investments, like Bosch has invested in a facility up in Sacramento. Are you expecting advanced manufacturing in California to contribute to growth in employment?
Yeah, that's a good question. So yeah, we are expecting that to eventually play a role. And so, one thing that happens with labor shortages is that companies are incentivized to automate more. So that is something that we think is going to be important going forward. But in the immediate period, we expect that weakness to kind of continue. One part of that is that a lot of the semiconductor growth is kind of investment at this point. So a lot of it's kind of construction. So it's going to take a bit of time before that really starts to come through into kind of the employment outlook. Yeah.
And I'd like to actually add to that. I mean, one of the things that I did not talk about for the U.S. economy, but it certainly counts for California, is foreign direct investment, right? So one of the stated aims of the industrial tariff policy that's happening right now is to induce more investment by foreigners into the U.S. and build manufacturing firms in the U.S. to produce more, right? But as Thomas, that takes time, and it's also, it's not a given that it will happen. It's a stated goal of the agenda, and based on the incentives, it makes sense that it should happen, but it's not a given either. So this is something that we're looking out for, and we'll certainly include more into our outlook as we do see it evolve. Yeah. I'll start with it.
Hey, I think this is a question for you, Clement. I think based off what we presented today, it's clear that the U.S. economy is kind of, I don't want to say propped up, but propped up by a lot of AI spending and infrastructure spending. We see a lot of that circular spending going on with NVIDIA and OpenAI, and that circular Oracle transaction happening. How do you feel about that, right? I mean, I was in preschool during Enron, so I know that kind of aggressive, forward-looking guidance is not the best thing to see at the moment, but it's a little worrisome to see this kind of a triad of NVIDIA to OpenAI back to Oracle and kind of circles. So
right. So what he's referring to with circular spending is the idea that a lot of these big tech companies are just paying each other, right? And the circular spending puts a negative tinge on it, and it is a concern, but it's also a natural thing that would happen because these are essentially vertically integrated supply chains where you have NVIDIA designing the chips, and then you have Oracle that buys the chips for the data centers, and then OpenAI that rents the data centers from Oracle, right? So it'd be hard to imagine this going on without it. And so I think this is one of the topics that is more current. I don't want to say fear-mongering, but it's something that I certainly do not see as a concern. I mean, it's inevitable that it would happen this way. And I don't think the projections on these are about the AI optimism is based on this circular revenue streams. Yeah.
That was a good question, Adam. I have a question about the minus 21,200 jobs that you were showing, and the key had Silicon Valley, it had Sacramento Delta, it didn't have a Los Angeles specific, and I'm just curious why.
Well, so it's just because that chart was trying to show where the negativity was kind of concentrated. If you look at the LA County data, it's not been so bad. I think if you looked at it, it would be a small negative bar. But generally, LA employment growth has kind of held up or stayed pretty stable. So that's the reason why we didn't have it there. There are some interesting differences across sectors. I know that in LA County, the healthcare sector is like a big contributor there. So if we had the healthcare sector, you would see that there are some pretty healthy positive bars there. But yeah, that's the main reason why it's not included. The other omission is San Francisco too. And there it's a similar answer where it's not really one of the regions that's been a really negative contributor. Yeah.
Can we get one final question from this side of the room? Yeah, sure. Yeah. There you go.
Thanks. So with the recent news of the BLS, statistician getting fired, are there any concerns over the data quality going forward? And how do we plan to deal with that?
I mean, I mentioned one concern, which is the fact that if the government stays shut down, we won't have any data that's going to be released. Right? For now, I don't have, I mean, I have concerns going forward, you know, things could deteriorate, but for now, I have full faith in the government statistics agencies. You know, the BLS commissioner doesn't even see those reports until after the fact, and it's just a stamp of approval. And I think, you know, generally speaking, the U.S. government labor force is something that's very, we should be proud of, and they do their jobs appropriately.
I think, I mean, one addition is that it's worth bearing in mind, so particularly for the case of California, you know, there's California-specific data collection that happens. There are a lot of the stats come from the BLS and the BEA, but also there are, you know, the Employment Development Division as part of California collects a lot of data. And I think that's kind of a bigger example for the US as a whole. There's a lot of people collecting data, right, that even goes beyond the kind of public bodies.
Right, so. Yeah. Okay, so that ends this section. I'll hand it over to you for the introduction.
Sure. Great. So I'm just going to introduce our special guest speaker. So we're very lucky to have Professor Geraldine Natz over to discuss the maritime industry with us. Professor Natz is a professor of practice of policy and engineering, which is a joint appointment between the USC School of Public Policy and the School of Engineering. She served as the first female director of the Port of Los Angeles from 2006 to January 2014, and prior to that was managing director at the Port of Long Beach. Professor Natz made a significant impact on the maritime industry through the creation and implementation of the San Pedro Bay Port's Clean Air Action Plan, which I believe she's going to talk about a bit today. In 2014, she was named a member of the National Academy of Engineering in recognition of her international leadership in the development of environmentally clean urban seaports, and currently serves on the NAE Council. That same year, she was honored with Containerization and Intermodal Institute's Lifetime Achievement Award, and she's been awarded several other prestigious awards and serves on a range of different prestigious committees. And then just finally, she is the author of several books about Los Angeles Harbor, and I believe you've been referenced, your career has been referenced in several other popular books. So that's very impressive, definitely things to add to the reading list. So thank you very much for coming, and we look forward to hearing you talk.
Thank you very much. So I kind of wondered why the Anderson School would want to hear reflections of a maritime person at a conference that deals with forward-looking trends. And then I saw I was sandwiched between two panels of economists, and then I realized I'm supposed to be your entertaining intermezzo. So I've been asked to reflect back on the early days of the San Pedro Bay Clean Air Action Plan and Clean Truck Program. But I also hope to share what I think the challenges that are being faced today, why they are maybe a little bit more, shall we say, challenging. Now, when I first joined the maritime world, I was told, oh, you're working in the maritime. You know what they say about the maritime. Well, of course you don't know, because I didn't even know. And so here it is. The maritime, 500 years of tradition, unmarked by progress. Well, of course, there weren't a whole lot of women in the maritime back then. So one of the radical things we did when I became port director was organize the first all-female trade mission to Asia. Me, my deputy, Catherine McDermott, and Cindy Mizakowski, our board president. So picture this. We're in a Shanghai boardroom waiting on the chairman of the board of one of the largest ocean carriers. He walks in, he sits down, he looks around and announces, shipping is a man's world. You could hear a pin drop. I looked at Catherine, I'm pretty sure we burst out laughing. In 2005, the Port of LA had not been able to get a project approved in 5 years. By then, the link between diesel exhaust and cancer was really clear. Communities were pressing for health risk assessments of port projects, but LA was not going there. They were working on a plan instead for no net increase of emissions. I was over at Long Beach at the time watching this unfold, and I asked my staff, run a health risk assessment of a proposed terminal project. The results floored me. Diesel truck exhaust was the highest driver of cancer risk, and the numbers were really high. I did not learn until many years later that in the course of my many interviews for the job at LA, I happened to say, we got to get rid of those dirty old trucks. And that remark put me over the finish line. But even before I started at LA, board president Dave Freeman pulled me into a meeting with AQMD's Barry Wallerstein. No net increase in emissions wasn't going to cut it. The communities were already impacted. When the meeting ended, Barry said, we need an action plan. And so we started one, the Clean Air Action Plan, or CAP. And a major component was the Clean Truck Program. We tied CAP standards to development rights, basically using CEQA to enforce cleaner practices. And the goal was to impose enough conditions on port development projects so that they would also clean up their existing operations as well. And to avoid unfair competition between our terminal operators, we use the tariffs to make the standards bay-wide. We were also going to ban trucks by model year, which back then was a 2007 or newer model truck. And the cargo owner had to pay a fee large, and every time they came into the port, large enough so that in the course of 18 months, that fee would be equivalent of purchasing a new truck. So business interests were not amused. Some thought I was crazy. The port was arrogant, because we were sticking our nose into port operations instead of sticking with our traditional role of building facilities and then collecting rent. Ports don't regulate air quality, they said. You don't have the right to ban trucks. The city attorney told me, do not say the words health risk in public. I was chairman of the American Association of Port Authorities, and I couldn't get enough votes from the board of the North American Port Directors to pass a resolution on air emissions. And when we went to the Federal Maritime Commission, a commissioner berated us for 20 minutes before we could even say hello. But the stars aligned. Mayor Villaraigosa told me, grow the port and green the port. Our board was chaired by Dave, the green cowboy Freeman. We had the right staff working on a war room mentality. And I like to say it took us 2 weeks to write the plan and then 2 months just to get the logos on the cover. I begged and cajoled until every agency, EPA, AQMD, and ARB, put its logo on the cover. So then we had a plan with standards, but honestly, we didn't really know exactly how we were going to implement it. It was a classic case of adaptive management. No truck could access the port unless they had a concession agreement with the port. When we started the truck program, the ports had no relationship with the trucking community. And there were so many independent owner operators, we were at a loss at how to corral them all. So we thought maybe they should be employees so we can work with their companies. You know, many people think that the Teamsters came up with that idea, but actually we stumbled into it ourselves. I can remember heading down to the mayor's office with Dave Freeman to meet with the mayor's staff to share this idea. And they looked incredulous. You want to do what? At one point, I told the Teamster rep that we were considering this, music to their ears, and they really jumped on board to push the plan. But then came the hearings, where owner-operators proudly described their one-truck businesses. My mom, visiting from New Jersey, sat in the audience cheering for them. Sure enough, the court sided with the owner-operators. The employee mandate was struck down. My mom was happy, and we figured out how to make it work with hundreds of one-truck companies. Privately, the terminal operators admitted some of the trucks were disaster on wheels. I would drive to work down the 710 freeway every day, and I'd see these big strips of tire tread all along the freeway. And I didn't know until one of the terminal operators told me that the truckers were literally nailing treads over bald tires. So many truckers were just scraping by. So the night before the truck ban took effect, I drove around the port scanning all the cabs, looking for their Clean Truck Program compliance stickers. We had to start with stickers before we had RFID tags. Not a one. I thought, okay, this is it. Tomorrow will be my last day at the port. Tomorrow the gates will be a mess. Trucks will be queued for miles. In the morning, almost every truck had a sticker. Who knew they'd wait till the 11th hour? But we still had a lot of blowback. My good friends at the Port of Seattle advertised the no truck fee port, big ads in all of the papers. And, you know, we compete with Seattle and Tacoma. But once the word was out, other ports started developing clean truck programs. When we would not back down on our right to ban non-compliant trucks, red light the ones that didn't meet our standards, the American Trucking Association took us to court. Long Beach settled, LA hung it all the way to the US Supreme Court. And while we lost the right to have placards on the back of the truck, how am I driving, and require off-street parking, we came out of that court case with our concession agreements intact and the right to red light trucks at the gate. And as my team identified the trucks, they would call Long Beach up, give them the VIN number so they could ban the same trucks in their port. So there was a time during this process that I have to say I was more afraid of meeting my mayor than meeting my maker. And I think this happened after a phone call from Target. We are pulling out of LA and moving all our cargo through Long Beach, they told me. And they were not the only ones that were unhappy that we didn't settle the litigation with the American Trucking Association. I had to go alert the mayor that we might lose 15% of our cargo and become the number 2 port. But Mayor V said, keep going. So we had the most aggressive plan imaginable and had to implement it during the economic conditions of 2008. But early adopters of clean trucks who did not have to pay the clean truck fee at the gate, they started advertising they had compliant trucks. And that started an avalanche of truck sales, and the entire fleet turned over in 18 months. Now, meeting the threshold for cancer risk set by the AQMD of under 10 in a million was really hard. The staff working on the first terminal project would come into my office and say, we got health risk down to 200 in a million, which meant they were imposing requirements on our operators to really reduce diesel exhaust. I would say, great, kick him out of my office, come back when you get down to 10. And they'd say, that's impossible. And I said, and my reply became my motto, it's impossible, it's difficult, it's done. So they'd come back and say, we got it down to 80 in a million, and I'd kick them out again. And so one time I was so frustrated, I said, just shut down the darn engine and float the ship at the main channel. I was only kidding. We know what happens when a ship goes cold in a navigation channel. Think Baltimore and the Francis Scott Key Bridge. So one day I'm in my office and I get a call from my chief pilot. Look out your window. And I looked out and there's a container ship out there like, look, Mom, no engines. My heart stopped. Since such a scenario could be modeled on paper, I convinced myself, but I did not ask, that this was their way of telling me they had crossed the hurdle of the impossible and were at the point of the difficult, testing different ways to find a solution. And darn it, it did not work. A third tug had to be put on that vessel in order to make it safe for navigation. And tugs have powerful engines. So we had tremendous reductions in air pollution in the span of 5 years. The community noticed ships were no longer belching black soot from their stacks because they were hooked to shoreside power, and dirty trucks were replaced with clean new trucks, and it made the harbor just look better. So early on in my tenure, I happened to be on a plane and I ran into Gene Pendamonte, who was doing government affairs for Maersk, the big ocean carrier. He told me, I've got a surprise for you. You're really it's going to be good news. And I'm like, please tell me now. I need some good news now. He didn't until Maersk announced they were going to test switching fuels off the coast of California from the usual high sulfur bunker to the clean diesel. Gene told me the captain said it was impossible. The ships will stall, will lose power, but they did it. And so burning clean fuel, once a vessel hit the boundary of that basin, became part of our cap. And we incentivized that the first year by paying the differential cost for all the vessels coming into LA Long Beach between the dirty fuel and the clean fuel. And of course, fuel prices skyrocketed that year, but it showed it could be done and the state followed with the rule. So that brings me to the current situation. From the beginning in 2006, diesel particulates have been reduced 91%, nitrogen oxides 72%, sulfur oxides 98%, and greenhouse gases 20%. So sure, progress was earlier. Progress was faster in the initial cap because we were plucking the low-hanging fruit. We were getting the fruit in the middle of the tree, and we were leaving some things on the top of the tree. In the early days, we were ahead of the regulators. We would try something, show it was feasible, and the regulators would follow. So what is different about today? First, the current cap goal is zero emissions terminal by 2030 and zero emission trucks by 2035. So that's kind of like electrifying everything that moves. Some terminals want to automate, which is extremely controversial. My current research at USC has focused on whether the benefits of automation pay off. But back then, the fear of losing cargo to an expanded Panama Canal meant several automated terminals were permitted with limited controversy. The initial cap required shoreside power, hooking ships to electrical power, which was pioneered at LA. But you may not know this. When there's a forest fire or an electrical shortage, the ports are told to tell all the ships, unplug and fire up your engines. So, and while there's zero emission trucks in the fleet today, industry has not jumped wholesale into adopting them for a number of reasons, including cost and insufficient charging stations. In my day, the infrastructure to support the clean trucks was already in place. So today, with limited power and charging stations and power issues, those current goals are a steep climb. Second, as much as the industry might not have liked the California Air Resources Clean Fleet Rule, we had a plan. The lack of federal support for that advanced clean fleet rule threw a monkey wrench in that plan. And OMEs who had retooled their assembly lines for, Class 8 zero emission trucks, that's not a minor thing to retool your assembly line. So it kind of created a regulatory void. Meanwhile, the AQMD is in an untenable position of having to come up with standards to meet without federal support for things that only the federal government can regulate. Well, there's not a lot of arrows left in the quiver at this point. And what the AQMD proposed to do is indirect source rule, making the ports responsible for emission reductions, not directly under control of the ports, with penalties for noncompliance. They started rulemaking some years ago and didn't get that far, tried to work with the ports, didn't get that far. But then as it got closer to rule adoption, the ports came back with what they call a cap plus. And the AQMD board decided, okay, let's continue with the collaborative approach. A collaborative approach has been the hallmark of the cap from the very beginning. And so progress is finally being made. Third, the maritime industry is no longer an industry unmarked by progress. The shipping industry has a pathway to decarbonization. The ocean carriers are now leading the global push to reduce emissions from shipping via the International Maritime Organization's proposed amendment to the Marine Pollution Treaty, and this is called the Net Zero Framework. It has new fuel standards, a carbon pricing mechanism, and mandatory greenhouse gas emission reduction targets. I spent a lot of years going to the IMO. I was not wearing a U.S. hat. I would wear the International Association of Port Authorities hat, because that way I could say what I wanted regardless of what the U.S. was thinking. And it's a good thing the global port community is there, because in April, the U.S. walked out of the meeting when the draft net zero framework was adopted. So 2 weeks from this week, October 14th to 17th, mark your calendar, that framework is coming up for a vote. And I hear that the U.S. is threatening countries with retaliatory measures, including tariffs, if they oppose. If it doesn't pass, then globally we fall into another one of these regulatory uncertainty spaces, which, as your last speaker said, certainty is really important. And, particularly for making investments if you want to move the needle on carbon-free fuels, coupled with also in another 2 weeks, the fee on Chinese ocean carriers and Chinese-built ships, which kick in. And now China in the last few days has adopted some measures to retaliate. It's going to be a roller coaster ride for the maritime. So let me end with something that is a dream of mine that has become a reality. I'm changing gears a little bit here. To me, the harbor has always been a place for moving goods, but also a place to visit, study, create, and invent. It is the world's best laboratory. And reimagining what several 100,000 square feet of empty warehouse, obsolete port facilities on 35 acres could be, well, you know how women like to fix things up. So with funding from the Annenberg Foundation, the project was kicked off out to sea at the Port of Los Angeles. So, and there's a shot of our West Campus that we finished last year, a $17 million renovation. This is the shot of our East Campus where we still have a lot of work to do. You know, I'm sure you all saw the recent news about the first ever wave and tidal energy demonstration that was implemented just a few weeks ago. And, you know, I have to say, it took 2 years to put a demonstration, to put those 7 pods on an abandoned wharf, 2 years to get the permits. We have to do better. There has been a global expansion of blue tech hubs in the world's seaports and waterfronts. This is the World Bank map of its investment in what it calls its Port Blue portfolio. Businesses and investors have discovered the blue economy and are financing maritime innovation and infrastructure for climate in the ocean. As one of the early birds in this arena, Out to Sea is not only a blue economy hub, but a convener of hubs. Our first foray into, I won't exactly call it franchising, but sharing what we do was in Kearney, New Jersey. And now we've built linkages across the globe in Europe, South America, Africa, and the Middle East. The Port of Los Angeles has always been LA's gateway to the global marketplace, and now through Out to Sea, it's also a gateway to global innovation and education. Thank you.
Are there any questions quickly for Geraldine? Any last minute questions?
Everybody wants their break.
Okay, well, we'll turn. Okay.
Hi. Thank you. Hello. Geraldine, hi. It's nice to meet you. It's nice to have you here. I'm Felipe Kuzner, Anderson. All right. Yeah. Anderson Milan from 2013. Proud to say that my summer internship was at the Port of LA in 2012. And you were the big boss then. So I'm happy to see you back on campus. My question to you is, as we're trying to remain competitive in the global shipping corridors, those regulations for clean air, for clean energy, for a lot of those restrictions or opportunities are imposed on port authorities that don't have the actual jurisdiction to rule over, as you just mentioned, to rule over the shipping lines and the carriers. How are we going to address this? Because for trucking, for shipping, for early, adoption of new technologies, there's a huge investment that has to come forward. How are we going to get the funding for that if the agency responsible for addressing those challenges or being put as responsible doesn't have the real authority to impose those restrictions?
Yeah, I have to say that most of the investment in implementing the Clean Air Action Plan came from the ports. And so they are actually, there is now a clean truck fee. It's a much smaller fee that they're collecting money now to help provide grants for the zero emission trucks. Not many takers, because a lot of people don't want to get, a lot of truckers don't want to get stuck someplace where they don't have a charging station. So, and in this CAP Plus, which is under deliberation right now on the MOU working with AQMD, both ports are making significant investments in infrastructure, charging station, alternative fuels, hydrogen. And so, yeah, the ports kind of lead the way, industry jumps on board, and it'll happen.
Thank you so much, Carol.
Yeah, thank you so much. This is fascinating. Is there any way for different ports to coordinate? So I'm looking at the map, and I am thinking of Chancay, the largest port in South America, and maybe on all of the Pacific now.
Right.
In Peru, Chinese investment. It's not in your map. Probably it's not clean as we are. Is there any way of coordinating that you would certify shipments that they come from a clean port to get to a clean port? And if it doesn't, if the port of origin is not clean, then there is a fee as a way to encourage everyone to start to do this, because of course it's a global issue.
Right, right. And you know, that's something, there is something in place very similar to that. The International Association of Port Authorities put in a program called ESI, Environmental Ship Index. And it basically requires the ocean carriers will apply to that program to get their ships certified under that program. And then the individual ports will adopt that program. And when a ship calls that's an ESI ship, they get a financial incentive. It may be a reduction in dockage or whatever. So that program is in place. That program, after the IMO acts, in October 14 to 17, assuming they adopt this new amendment to MARPOL, then that environmental ship index, the criteria has to be changed. We elevated to be advanced to match the new amendment to the treaty, and the ports will then re-adopt those programs. But it's not a penalty as much as an incentive. So.
We are going to head to break. We're going to reconvene at 10:35, so that's an extra 5 minutes on the schedule. Okay, I'm going to thank Geraldine. All right. Okay, everyone, welcome back. We're going to get started. For the rest of today, we have two wonderful panels. The first one is on climate risks, and the second one is on the economic effects of tariffs. All right. So for the first one, moderating it, we have our very own Maggie Delmas, Professor of Management here and the Director of the Center for Impact. So thank you, Maggie.
Thank you, and good morning, everyone. So we're going to change gear a little bit from, kind of economist forecast to climate forecast, thinking about the future of our climate, and talking about data, which is really extremely, related to the forecasts. How do we predict the future, and how much does it matter for, kind of businesses? So my name is Maggie Delmas. I'm a professor at the Anderson School of Management and the Institute of the Environment and Sustainability, and the faculty director of the Center for Impact. And I'm joined here with three wonderful panelists, and we'll just introduce them a little bit in a minute. But first, I wanted to tell you why we are talking about this. And the next slide. Thank you. So here we are. So we all know, kind of the risk of climate change, but what is happening in California right now is our new regulation. And we just heard from the previous speaker about, all kind of the advances that have happened in the last few years with, kind of the ports and their impact on the environment. The California Air Resources Board is moving forward with more regulations, asking companies to disclose their climate financial risks. And the deadline is January 1st, 2026. So this is kind of something really new for a lot of companies. This is for companies that are actually operating in California, doing business in California with more than $500 million of revenues. There are about 4,000 of them. The list was just issued on the California Air Resources Board website. So what do firms need to do? And what, we want kind of to understand how they will do that. Next slide, please. So what do they need to disclose? So they need to disclose, their metrics and target, what exactly their emissions are. They need to disclose their risk. What are the risks, the climate risk in the future, in the long term? They need to disclose what strategy they're going to put in place to mitigate some of this risk. And then who is going to be in charge? These four elements, which are being kind of issued by some standards like what they call TCFD, the Task Force on Corporate and Financial Disclosure, which is what firms will have to disclose. So this is a lot of work for companies that have never done it. It's not just for publicly traded companies, it's for companies doing business in California and are, kind of above this threshold. At this point, there are 70% of publicly traded companies, S&P 500, the biggest firms in California, who are in the US, who are already doing this. Disclose this risk. And what we've done is at, the forecast is issuing the forecast. The Center for Impact is issuing every year the state of corporate sustainability disclosure that tells us what firms are currently measuring in terms of climate, and environmental issues. So what we see here is that in terms of risk, we see about, kind of 30% talking about flood, extreme heat, 24%. So it's like a quarter of the companies are disclosing some of this risk. With this risk, flood, extreme heat, and wildfire at the top. How do they do this? How do they make this assessment? What data are they using? That's really kind of the question that we are kind of posed here with experts in the field. Next slide, please. And then firms are doing, and kind of other things, not just climate risk, but when we talk about climate risk, it's not just the physical risk, but also the transition risk, the regulatory risk, the market risks, new technology coming in, reputation risk, technology. All of these are things that now firms need to take into account in their own forecasts. Next slide, please. So the questions for this panel are the following. How companies evaluate this, different climate scenario? What type of data kind of do they use? How research from institutions like UCLA can inform this work? And we have here, kind of really the star of our, climate assessment modeling at UCLA. How the insurance industry uses data to evaluate and price the climate risk for corporations. So we have three amazing panelists today, and I'm going to ask them to introduce themselves, but they're representative of A, the research, B, the industry, Southern California in Edison, and 3, the insurance industry. So we have these 3 kind of representative here. So I'm going to just start the panelists to just introduce themselves, just maybe 1 or 2 sentences.
All righty. Well, now we're all paying attention. My name is Karen McKinnon. I'm a professor here at UCLA, and my research is on climate science and statistics with a focus on extreme events.
Hi, good morning. My name is Anna Brockway. I'm the interim lead for climate adaptation and resilience planning at Southern California Edison. And at SCE, I lead work on understanding how climate change exposure is going to affect our service area, prioritizing those identified vulnerabilities and trying to understand how we can best develop adaptation options to address them.
Good morning, I'm Bruce Ratty. I am an insurance broker, so I represent clients who are customers. We go to the insurance companies and place the insurance for them. And we use a lot of climate data to do that.
Okay, so Karen, let's start with the science. Can you tell us a little bit, like maybe a 101 of climate science, climate modeling? What type of data do you use? How do you do things?
Yeah, thanks, Maggie. Obviously a big question, but I do want to get everyone on the same page in terms of what we're talking about, what we know about climate change, how we project it, what data we use. So I first just want to distinguish between the different types of information that are often used by industry. So one would be historical observations. So these are things where we've, say, measured things like temperature on the ground in the past or through satellites. We have a kind of rich set of information about what's happened in the past. And we are, of course, observing climate change, and we have been observing it. And so this past data can be helpful for us to understand kind of how climate change is manifesting. When we move forward looking, things get a little bit more complicated because we really have different types of information on different timescales. So I think the most obvious forward-looking information, really more on weather than climate, but probably everyone here has looked at a weather forecast at some point, probably this morning. Maybe not in LA, actually. We don't look at our weather too much here, but you know how that works. And so you can look out, say, a week, in some cases, maybe 2 weeks out, and have a pretty good idea of what you're going to get in terms of what happens when you go outside. Once we go beyond weather timescales, things get a little bit more complicated because we can't kind of deterministically predict what's going to happen in the future. So I can't tell you, in 2027 on May 1st, what the temperature is going to do in kind of a fundamental way because our climate system, our atmosphere is chaotic. And so we use climate models to make these future projections. And those, some of them people do more like subseasonal, so that could be like, a few months out. But as we go to more decadal long forecasts that people are increasingly using, those are basically coming from numerical models that ideally represent the physics and the dynamics of the climate system. And they are basically controlled, or the future projections that are made are a function of both, of course, those physics of the climate system, but also a projection about what we expect will happen in the future with our own behavior. So what greenhouse gas emissions will we emit? What aerosols will we emit? How will we change the land use? Things like that. I'll stop there, but happy to go on.
Okay, so just a little bit more about your own work would be useful. And where are the uncertainties?
Yeah, great question. So in the climate world, we've actually defined, I think, a relatively helpful framework to think about uncertainties, particularly for projections. So one source of uncertainty is kind of the last thing I mentioned. It's actually what we're all going to do. So we don't totally know how human society is going to respond to climate change, if we're going to kind of meet the Paris Agreement goals or not. There's obviously uncertainty there that folks in this room are keenly aware of. So we in climate science call that scenario uncertainty, but what it means is basically, we don't know quite what humans are going to do. We also have kind of fundamental physical uncertainty. So our climate models are not perfect. We're trying to model a very, very complicated Earth system, and there is uncertainty in doing that. So, a good thing to keep in mind is when you look at climate model projections, there are uncertainties in the physics that underlie, or rather our ability to put those physics into a numerical simulation that are present. And then the last source of uncertainty, I think, is one that's a little bit underappreciated and a major focus in my research. This is just called internal variability uncertainty. So as I mentioned before, our climate system is not deterministic, it's chaotic. If people have heard of like Lorenz's butterfly or things like that, that refers to some chaos theory. But the main idea that I mentioned before is we can't make a perfect projection of what is going to happen in the future. And so that means when you look at future projections, you really need to think about distributions. You need to think about a range of conditions that could occur, even given a single, trajectory of human behavior, even given a single climate model simulation. And as you go, like the importance of each of those uncertainties depends on time scale. So as you go out from maybe a year or two from present, that internal variability uncertainty is a big deal. And then as you go to longer and longer timescales, that human uncertainty becomes an even bigger deal because it's just hard to know exactly how we're going to operate in these coming decades.
Yeah, so that's very interesting. So human versus physical uncertainty, but there's also local versus global. So if you're in California and you want to know what's going to happen here in Los Angeles, how feasible is it?
Yeah, that's a great question. And I'm really glad you brought up that point because I mentioned timescales, but not spatial scales. So as you go to larger and larger spatial scales, the climate change signal becomes more and more clear. So if anyone here has ever looked at a time series of global mean temperature, it's kind of going up, it wobbles a little bit year to year, but there's this pretty clear trajectory that is very much due to human influences. If you looked at kind of the evolution of California temperatures or even worse rain, precipitation, then it would be much more noisy, and that's due to that internal variability component. And so as you go to these smaller scales, it gets harder and harder to predict, both because the internal variability is large, but also the very specific physics, for a specific location, it's going to be more likely to have errors.
So how do we bridge that? I mean, is it possible, that some of the work that you do, and Karen McKinnon is really one of our stars at UCLA in the Department of Atmospheric Science. So is it possible to give some kind of information about California and where things are going? Is there some work that is, along those lines?
Yeah, I like to kind of, bring up kind of two tiers of information that are available. So one, I kind of think is the common sense information. Things are getting warmer. That is extremely simple, and we know it to be true. We don't need a lot of information. And in terms of adaptation, we also can kind of look at our current climate and understand what future risks will be. So if you look at a place that currently is hot, it is going to get hotter. It's already at risk, it's going to get worse. If you look at a place that is currently in high wildfire risk, warmer temperatures mean greater wildfire risk. That wildfire risk is going to be amplified over time. So I view those as kind of the common sense predictions. Even extreme precipitation, we have some kind of fundamental understanding of. We do expect in most cases extreme precipitation to intensify due to some fundamental physics of the atmosphere, although there's a lot of noise year to year. So it's something that's a little bit harder to kind of predict as effectively. But the other tool that we do have is that people, primarily Alex Hall, who's another colleague here at UCLA, do work with these large climate models I mentioned before and use a range of kind of advanced techniques to try to bring those global models down to the regional scale. And I'm curious to hear from my colleagues about how they use them, because I think those are used in various ways, kind of, outside of the ivory tower. But in those cases, we're kind of taking, the understanding we have of the physics of the climate system, trying to bring it down to California scales. The uncertainties I mentioned before remain. And so I think what's really important as this climate information moves from, academia to private sector to policy is to ideally keep climate scientists in the loop, because there are kind of a lot of scientific complexities. It's not, climate modeling is not just like weather modeling. Weather modeling is more advanced, it's simpler in some key ways. You can't view a climate model output the way you would view a weather prediction. So information is certainly there, it can be useful, but there are kind of important things to keep in mind before just kind of, taking this output and just moving it through a report.
Yeah, I'm really interested in how kind of we bridge this kind of, gap potentially from, kind of research to practice. And I think the California climate assessment map is something that might be, helpful. And that's what you're referring to with the work of Alex Hall. So, I mean, moving to Hannah, the question is, okay, now kind of you are on the other side of, a practitioner trying to figure out what climate is going to be in Southern California. Edison is a company that has been, kind of very impacted by climate change. And so which data do you use, and how do you kind of work on this climate scenario in practice?
Thank you so much. Yeah, it's a great question, and it's a complicated answer. So historically, electric utilities and the critical infrastructure providers in general have pretty much used only exclusively historical data to plan for the future. Now, obviously, the climate is changing. We can't really do that anymore, at least not responsibly. And so we really do need to rethink our methods and incorporate awareness of how the climate is changing. We are one of the nation's electric utilities. We serve about 15 million customers in a diverse range of different climates. We have customers in coastal areas and desert areas and alpine areas. And so we need to understand how climate change and how exposure conditions are evolving in all of those different places. I want to make a distinction between kind of short-term operational planning and long-term planning. For short-term operational planning, and this is on the scale of hours, days, weeks, even months, we're really looking at kind of real-time weather conditions and short-term weather forecasts. And we have in-house meteorologists who are amazing, who do a lot of that work and work really closely with those kind of on-the-ground teams making near-term real-time decisions. I don't do that work, so I'm not going to talk about that today. The work that I do and that my team does is really much more focused on the medium and long term. And so we are the ones who are taking in this climate information from climate projections, from California climate models available through CalAdapt, which is a website that a lot of the climate scientists in the state essentially contribute to. It's set up to make this climate projection information actionable for practitioners. So we pull information from there, and then we take it in-house. We look at it to try to understand what's actually happening in our service area on which timescales. And then we pull in engineering experts from all around the company. Our folks who work on transmission distribution, our poles and wires, right? Our generation resources, our telecom, communications, corporate real estate, to help us make sense of how those projected changes might actually impact the specific assets that we have on the ground. And so the work that we do that my team really facilitates is kind of this constant iteration between the climate information that we're getting from climate scientists and the engineering judgment of our in-house experts and kind of their best industry knowledge about how some of this work might really impact the things that we do.
Just Hannah,
yes,
could you provide just one very kind of practical example of what you mean by long term, and one example of an impact that you measured?
Absolutely. So one example that I think is really interesting and love to talk about is when we talk about extreme heat, it's kind of common knowledge, right? That when the temperature rises, people are going to use their air conditioning more, and that's going to lead to greater demand on the grid. Perhaps less commonly appreciated is that same increase in heat also has greater thermal stress on our electrical equipment, on our lines, on our transformers, on all of the equipment that actually makes the grid work and moves electrons from place to place. And so, but those impacts are more complicated. They're not as well understood from like a first principles physics work that we're trying to do is essentially trying to characterize those impacts. And so to be able to say, okay, if we have this many more extreme heat days, if we have this higher average temperatures, how much faster is our key transformer, our kind of key piece of electrical equipment actually going to degrade? How much faster is it going to fail? How do we then start to make assumptions around that to actually price them into our financial modeling, our kind of supply chain modeling, our ability to have the equipment on hand that we need in case that equipment does fail?
So it's not just climate modeling, it's also engineering and economists you just mentioned, right?
Absolutely, yeah.
Okay, so that's kind of, so what do you think is, the missing piece, the thing that you think, researchers should kind of help you kind of, get more certainty of?
Ooh, that's a good question. So we work really closely with the climate science community and climate science researchers. So I think we actually have really good communication channels between the climate science community and the type of work that we do. And we have a lot of questions for them. And we are constantly talking to them and constantly saying, hey, our engineers, our planners need data that looks a certain way, like looks this way, to help give them insights about what to do. Can you help us take these climate projections and kind of massage them so that they fit this need, but do that in an appropriate way that's really true to the scientific kind of underpinnings of the data itself. We have greater certainty around temperature than we do about things like flooding and flood depth specifically. So it's some of these, like these core climate variables like temperature and precipitation are better characterized in the climate science than when you would need to put them into downstream models and say, now what is my flood depth in a particular location on the basis of what precipitation rate has fallen, for example. So there are definitely plenty of gaps, but it's kind of a constant iterative process for us.
Okay, and if I'm thinking, going back to SB 261, so you guys are ready to disclose all of that information, right? Or you're not in the scope?
We are, yes. So we certainly think that we are. And we also file a sustainability plan every year where we share a lot of the information around how we're incorporating climate information to plan both for near-term risks and for these longer-term risks. A lot of that information is really documented in that sustainability report, and our intention is to essentially use that as the underpinning for our disclosure.
Okay, what is long-term for you?
We're looking at 2050 risks at the moment. Yeah,
okay.
That's our longest time horizon that we're looking at.
Very long-term, yeah. Moving to Bruce now, just in the insurance industry, you're an underwriter. What do you use? What type of data do you use in the industry to kind of establish your rates? How much of the climate modeling is part of that? Can you please let us know?
You have to address that. So as I mentioned before, I'm an insurance broker. I'm not an insurance company. So we don't set the rates. We work with the underwriters at the insurance companies that work on the rates. They have very detailed modeling that they use, especially for wildfire. Am I too loud? So CoreLogic is one of the huge software programs that is used. Most of the insurance companies that you've heard of, like Hartford and Travelers, they all have their own modeling that's secret. But the algorithm does include a lot of climate data, mostly looking backwards. And they include the forecasting and the modeling going forward, but they look at 200 years of climate data, and they kind of base their rates off that with the caveat that, yes, the climate forecast will make a difference. It is interesting that down to the geographical location of a building, these modeling will tell you what exactly the brush clearance is, what exactly the type of brush. So believe it or not, like chaparrals, like if you go out into Riverside area, these type of chaparral brush has a high oil content, and it's very difficult to extinguish. It protects the plant, but it's hard to extinguish. So that makes a difference when it comes to setting the rate. So there's a lot of things, and of course, the past losses are always contemplated when they're pricing a risk, but those are some of the things. But the climate is definitely in the modeling. And again, most of it is looking backwards with a small glimpse looking forward.
What type of model? Do you know what type of models they use?
Yeah, CoreLogic is a primary for most of the property insurance underwriters. Like I said, a lot of the bigger companies utilize that, and then they have their own proprietary software that they don't give anyone access to. It's like the secret sauce. Like nobody knows 13 special spices in it, but it includes all of those things, including the brush data and the satellite imagery.
Yeah, that's the difference between academia and businesses, is the lack of transparency on how things are done. So how do you, I mean, how can you predict, what will matter in the next, kind of iteration of the rates? And do you think that like the disclosures of this information from companies now, public disclosure of the climate risk will have an impact on the insurance rates?
Senate Bill 261, I believe will have an impact, and underwriters will look at those as part of the tool on the rates as far as modeling. But realistically, they're going to look at the data based on that property, based on what the location is, what's inside the building. If it's a woodworking shop versus it's an accounting firm, it's a big difference. Those things, nothing to do with climate, but the climate is a big piece of it when it comes, excuse me, to evaluating what the artificial intelligence helps them to assess, including the predictors and the weather forecasts.
So, I mean, I wanted to also kind of make sure that the panelists could ask questions to each other. Do you have questions you want to ask to each other?
I have a question for Anna. So I learned this a few years ago that, people ask sometimes, well, why, the wind's coming, why doesn't Edison just throw the switch and shut the power lines off? It takes quite a long process to decommission the lines. I'm not going to say it right. So can you respond to why doesn't the electric company just turn power lines off immediately? And how quickly?
Sure. So I think there are a couple of different questions in that question. One is about turning off electricity service to a particular location to reduce the risk of ignitions. And the other, use the word decommission, which is actually taking infrastructure out of service and removing it from a particular area. De-energize. Okay, great. Thank you for clarifying. Yeah, I mean, so I will caveat that I am not the decision maker in any of these scenarios. I'm not intimately involved in these kind of operational near-term decisions. What happens though is that there is a large team of people who are constantly monitoring weather conditions, who are constantly monitoring fire conditions and wind speeds and making that decision in a really like near-term real-time basis. And you're constantly weighing, what is the risk of a fire starting or igniting in this location to the harm that's done to communities when they don't have that electricity service, right? And so it's every situation you are having to make that calculation. Yeah.
Karen, you wanna?
Yeah, I had a question back to Bruce. I'm wondering, and maybe you'll feel that you can't answer this, I'm not sure, but if we kind of look forward at the future of insurance, so many people in this room, actually myself included, have had the experience of their insurance being canceled in response to, well, I think probably in the large scale in response to climate changes, although that might not be the specific thing on the cancellation form. Similar in Colorado, I have friends who've their insurance has been canceled almost every year in their HOA association. It's obviously unsustainable. What do you think is kind of the future of insurance coverage and stability, given that we're all on this climate change shift together?
That is a brilliant question. I will start by saying this. The insurance industry as a whole is doing very well right now. The property insurance rate hikes of 2023 and 24 have paid off. The reinsurance companies, their coffers are full. So how it works in insurance, let's just say you have a $100 million building. Travelers is the insurance company. They only take the first $1 or $2 million of that property risk, and then they buy reinsurance on top of that. So that's a global climate situation with the reinsurance pricing. The other thing I'll mention is the California FAIR Plan it's broken, it's insolvent, it's held together by paper clips, and we need legislative changes with the climate people to help make our Sacramento make this whole program whole, because right now it's completely insolvent. There's a plethora of lawsuits going against them. So I don't know if that answered your question, but I thought it said some of these things.
So I think what we are seeing on this panel is that all these kind of climate change risk are impacting, many decisions and, probably the economic forecast. So I hope that in the future, the forecast will take some of these data and integrate it in the forecast as it becomes so much, kind of much more central. I wanted to kind of open up to questions in the audience. Yes, Thomas? Do we have another mic, maybe?
So we advise companies on things in the future. And one of the things that we tell them often is that the present is the future that you didn't see coming. And one of the things that we find is their data is historical. We don't have any data about the future, obviously, but one thing that holds companies back from changing their behavior or changing the way that they look at or think about the future is that they don't have language. And I'm looking at you because I'm particularly interested in Edison, how you're thinking about the future, but how are you talking about it? Are you actively thinking about using different language so that you can change behaviors on what you do in the future?
Let me see if I can answer your question. So we have strong buy-in across the company about the need to plan for the future and to use climate projections to take climate change seriously. This is the future that we are heading into, and I think there's a lot of awareness and buy-in to that idea from our highest levels of leadership all the way down. In order to actually affect that change, given the variety of very kind of process-driven, engineering judgment and engineering modeling that we do across all aspects of our business, what we found is we really need to do the most we can to make the climate projection data look as much like historical data as possible. And so what I mean by that is if there is a planning process that's taking an hourly time series over a 10-year period in order to spit out a particular outcome that says you should, invest in this location and build additional capacity, we need to take climate projection data and we need to give them an hourly time series of 10 years of data to plug into that model. And so that is a lot of the work that we do with the climate science community, is essentially saying, we have this need. This is what we need the data to look like in this kind of format. Can you help us look at the climate projection data and make it look like this? We want it to be representative of the future climate on this time horizon, whatever the planning time horizon is for that process, but we need it to look like the old data. And that's really how we get past some of the kind of logistical hurdles of saying we have a really complicated process where we can't change the process all at once, but we can make it more forward-looking.
I think this really touches on the governance.
Yeah.
I mean, you can have all the data you want, I guess, if you don't have and all the scenarios, because what you're doing is actually issuing a few different scenarios, but then what? What happens? And I think that's kind of the question from this, kind of disclosure regulation is, okay, companies are going to disclose the risk potentially, doing a better job at that. But then they also have to disclose the actions and the governance. And that's, I think, another layer of complexity and difficulties as you express, because your process are in place. How do you change these is really important. So it's not only climate scientists, engineers, economists, but also maybe organizational theorists and management scholars you need to bring to the equation. There's a question out there. I'm going to you.
Thank you. And I don't want this to seem like it's just a SCE beat up question, but being an economic forecast and talking about climate change, one of the big issues for manufacturers or people that use a lot of energy is energy reliance. And when I hear the comment, well, why don't you turn off the power when the wind blows? That really scares me, because businesses shouldn't think like that, that there's a normalization that their power will just be shut off. Because it doesn't happen everywhere. The wind blows everywhere. So what part of your work is helping create reliance in the grid so we don't have to shut off the power?
Yeah, good question. So our main document that we use essentially to understand our climate projections and our potential impacts to our grid is something called the Climate Adaptation Vulnerability Assessment. This is a filing that my team is responsible for. We have done one so far. We were the first utility in the state of California to do this assessment of our climate risks. We are filing our second version of this in May 2026. That is most of my job right now, is essentially working through the final analysis for that filing. And what that assessment essentially seeks to do is understand, where is the climate changing in our service area? How is that going to affect the different assets and equipment we have? And then what should we actually try to do about it? And so in some cases, that can be proposing to harden some of those assets. In some cases, it may be proposing to replace some assets. In other cases, it might be saying we need to update a standard so that, equipment that's already there, fine, we'll kind of take it. but future equipment that's built in this location should be built to XYZ standard, right? So, and these are decisions that have to be made really on a case-by-case basis of really understanding how that particular type of engineering equipment works, what is it sensitive to, and what kind of exposure might we be seeing there. But yeah, those are some of the strategies we have to do that.
Thank you. Bill, Professor McKinnon, like you've been left out of this whole thing. So I guess like two small questions. One, like, have there been headwinds for you? Like a lot of my background's in analytics, like if only there's a way we could like look at the past data to maybe make a storyline for the future. Do you feel like there's a lot of headwinds in, I have this data, as business, of course not as you, but like business, like here it is. If it goes contra to, what makes the ticker go up, do you see that there's a lot of kind of pushback? So it's like, oh, if only there's data, really, it's just, we want data that maybe supports our business plan. The other one quickly is just, I know that AI and other things like have caused a lot of additional energy requirements. I'm more or less from Texas, so I'm from two states that have, interesting power grid, electrical grid structures. Has there been any talk of like looking toward other, we all hope fusion and fission are here soon, but like atomic power, just other, alternate forms of, like, I guess, generating more power because we'll need it. Thank you.
Yeah, in terms of use of information, climate scientists have been projecting climate change pretty well, actually, for at this point, I'd say 50 years. But I would argue, I just read a great book by Susan Solomon called Solvable. I'd recommend it if folks haven't heard of it. But she makes this point that in order to solve environmental challenges, one of the key ingredients is climate change being perceptible. And I think that maybe in the past 5 years, climate change has, for many people, become very perceptible. Our state of knowledge has not changed that much in 5 years, but we just got to the point in the graph where people are like, oh, wow, like my house burned down, there was a heat wave, there was flooding. I mean, just a lot of stuff is happening. And so I think that it's, and I think understandably as humans, it's hard to act on future projections when they seem really different from the present. So I forget what you said, but the present is the future that is now or something like that. And it's like, we're kind of now there, I think, for climate change, is that we've known about this for a long time, but now people are experiencing it. And I think that's why there's been a lot of movement recently on actually saying, okay, let's try to take this information and say something useful, or do something useful, I should say.
We do kind of modeling of the electricity grid in the state of California to try to understand, how is our demand changing? How is climate policy in the state of California changing? What we expect to see for demand in the future, more electric vehicles, more building electrification, that type of thing. And we also try to understand the generation that will be needed to actually fulfill that demand while staying true to the state's climate goals. And one of the pieces that has really fallen out of that modeling in recent years is the importance of clean, firm generation, which is essentially, clean generation that is able to kind of really operate and meet that baseline. Various forms of nuclear could meet that. Various forms of geothermal could meet that. We are not a vertically integrated utility. We procure a lot of power from others, so we are not the ones necessarily making those investment decisions. But we are trying to understand what will be available to us, right, to meet the demand that we need to meet. And so, yeah, there are certainly active policy discussions on that right now in the state.
Yes. So I'd like to say, first of all, I think this is a fantastic topic. And Maggie, I think you're in a wonderful position, because to have Karen, Anna, and Bruce, we have academia, we have the electric company, and we have the insurance company on the same panel on this topic. I don't know if that happens anywhere else, first of all. But you made a comment that having academia and corporate thinking of this problem in two different ways, and I think that's huge. And I had a number of questions that came to mind, and I think I've refined them down to two different things. One is fire hardening, and the other one is predictive analysis. And when I think about that, fire hardening, I think more from the academia side and possibly from the SoCal Edison side. And then when I think of predictive analysis, then obviously I think of our insurance guy, Bruce. So Bruce, when you look at a grid and you look at everything that's involved in that grid, there are particular types of trees that may have the oil, which means it takes longer to put the fire out. And then when you look at it from the electric company side, where we've got the power lines going over, we've got the poles, the metal poles, and can they be hardened? Number one, the poles. Number two, can the output of the lines be hardened? And then number three, knowing that we're continually getting hotter, and on the academic side, we said that's going to result in more fires, exposure, and higher winds. How do you harden the ground beneath the poles that have the lines? So you've got a number of things in there. So I guess the real question, again, when we go back to fire hardening and asset protection of that, if you have this grid and you say the cost of insuring anywhere in this grid is X, and I move into that grid because my family just loves it and we have to be there. If I harden one particular piece within that grid, now do I have material to go to your company and try to reduce that cost?
Very well thought out question. What's your name? Otis, thank you. I'll address the fire hardening question real quickly, both from a residential and from a commercial perspective. Obviously, clearing the brush. 100 feet is what the insurance companies are looking for actual brush. If you have pine trees 10 feet from your building, they're probably going to say no, thank you, because those are just towers of inferno. A lot of things can be done. The coatings can be increased to be fire retardant on a house or a commercial building. Number two, for a commercial building, a lot of you see these pallets stacked up in the back of a building. Those pallets are just waiting to become a Burning Man bonfire. Nobody wants that. So the wild card in a wildfire is the embers. They can fly for miles and start a fire. So another thing is vents. You can put vents with mesh in them that will reduce embers entering, and clearing the gutters, get those gutter guards or whatever to keep any leaves or pine needles on your roof, get all that cleared out. Those are the type of things. And what we're seeing from a commercial standpoint is these $100 million building structures, you're having to install your own water tank with your own diesel fuel generator to be able to pump water and have an external sprinkler system to protect your perimeter. I believe, and I can't verify this, but I heard this morning that Caruso's development in the Palisades didn't burn because he had done a lot of these hardening efforts. So that's hopefully that answers your question on the hardening.
Yeah, so I think the main one issue here is about, kind of adaptation to the risk and the problem that there is maladaptation, the problem that you are kind of fixing a problem here, but you're creating another problem here. So that's also part of the difficulty to take action based on this kind of information. It is that, you could have protective, kind of elements that really have an environmental impact, air pollution, or so that's kind of also another kind of dimension of the complexity. I wanted to just take one more question and then we need to close.
I will piggyback on what he said. Thank you guys for coming together from different factions. I'm curious about the collaboration with global research. I'm sure in academia, you guys are in contact with other countries and other institutions. I'm wondering about, excuse me, the electric or the power companies, if there is a similar collaboration with other types of clean energy providers, if there's shared learnings. I understand from the insurance standpoint, proprietary information, you don't want to necessarily give away the secret sauce, but I'm just wondering about outside of this area, outside of the United States, are we seeing other countries that are doing this well? It's different everywhere, but are there findings that you're sharing and learnings that could potentially, diversify the electric sources, like you said? So, yeah.
Yeah, there are certainly industry forums and spaces for electric utilities and others in the electric industry to share information. I'll answer your question with a focus on adaptation specifically, because that's really where I work and where I know it the best. Adaptation is a new topic for critical infrastructure providers and for electric utilities. This is new, and I'm proud to say that we really are at the forefront of it here in Southern California. We have participated over the last few years in a forum convened by the Electric Power Research Institute, or EPRI, which is an international, global, essentially research body that works specifically with electric utilities to share knowledge across various topics. From 22 to 25, they convened a new effort called the Climate Resilience and Adaptation Initiative, or Climate Ready, where they actually did a lot of this work to understand how this affected the electric power industry, what kind of climate data electric utilities globally could use to try to answer some of these questions. We're really lucky in the state of California to have the state investment and the data resources that we have. That is not the case in most places, either within the United States or outside of it. And we really are at the forefront is really one of the things I learned in that initiative. So the industry is working on it. It is convening, it's starting some of those conversations. I'm very confident that we're at the front, at the cutting edge.
Oh, thank you. I'm going back to, and just to conclude, going back to, kind of this new regulation that are kind of coming into place and firms having to start with climate risk, and some of them have never done that. Any advice from each of you on, what to think about when you think about climate risk? Go first.
Bruce, go ahead.
What I think about when I think climate risk, I mean, it's real in my industry for sure, especially with the property placements. As I mentioned before, I mean, one thing, people can harden their homes, people can harden their properties and commercial buildings, but climate risk is real. We're not scientists, we're just insurance dorks. And we use analytical data provided sometimes by the universities that goes into these modelings to help us. But at the end of the day, like I mentioned earlier, the insurance industry now is stable and it's very strong. But climate is the wild card that we can't control. We don't know. The crystal ball doesn't focus and it doesn't tell us. So we just know that we need to be ready. Like for instance, right now we're entering the beginning really of the phases of the hurricane season, and we have no idea what's really going to happen because the big ones are still coming. So it's just unknown, unfortunately.
So in the context of specific compliance with SB 261, I think one of the things I've really learned is that internally you need to work with a whole lot of different people in order to make that disclosure and really that sharing of information possible. So within SoCal Edison, there are a variety of different teams who are essentially working on that, including, I have a list, sustainability, environmental and air quality, corporate governance, enterprise risk, corporate safety, all involved in the process in addition to our team. So it's a vastly interdisciplinary effort. I would say from my perspective of really thinking about climate adaptation and kind of documenting this long-term climate risk, understanding how it applies to us, one of the things I really end up doing the most day to day is just translation. These are highly technical topics that we're talking about. They really reach down to the core of kind of cutting edge scientific technical knowledge across a wide variety of fields, and understanding what the climate scientists are saying and then translating that to what the engineers are saying and what they understand is a huge part of my job. And you really have to get down into the weeds with folks who have really deep specialized experience to really know the kinds of risk you're facing and to be able to then scope out how do we adapt to them. So don't underestimate the kind of technical challenge, even once you have that corporate buy-in and governance and will to act on it.
Cool. Thanks for giving me a moment to collect my thoughts. Yeah, I just want to make 2 points. One is actually perfectly piggybacking what we just said, is that, in some cases, I do, some consulting. I work with companies and they'll come and be like, oh, can you just tell us X? And I'm like, X is actually like a cutting edge thing that I could get like a Nature paper for figuring out. Like, I think that sometimes people, in the business world or the policy world don't realize how much the questions that we really want to answer, unfortunately, they're not like textbook questions. It's things that we're actively trying to figure out in the climate system because the climate system is really, really complex. That said, not to leave everyone feeling depressed, I also think it's important to think about what's the true granularity of knowledge you need. And I, was kind of struck by your comment on the hourly time series thing, because that demands a level of granularity that's super high. At this location, I want hourly data, and I know that's what your engineers want. Yep. But the question I sometimes have is, there's a lot of things that we do know. Like, like I mentioned, like the temperature one is the easiest, it's going to get warmer. Does it matter that much, if that's 2 or 3 degrees, or even if we know the sign? Like, is there a way to incorporate more kind of, confident, but not quite as quantitative information into the processes? So I think that would ease a little bit some of this, like, feeling like you need to be at the cutting edge issues by saying, okay, what are the things we really, really know, and can we incorporate those in that process as well? But yeah, and then that last thing I wanted to say, and Bruce brought this up a little bit, is that when we think about, if you think about climate risk, which I'm going to broadly think about as the risk, due to weather events at the end of the day, some of this is climate change, but some of this is just the climate risk that we have, just even without climate change. So, we would have wildfires even without climate change. And so there's not only a need to think about how the climate is changing, but also just the inherent variability and natural extremes that are produced by our climate system. And then you combine that, of course, with the really important human vulnerability part. And so in some cases, the failure in, various things that are tragic or costly is not so much that we didn't know what was happening on the physical climate system, but that we weren't actually prepared or adapted, or the information wasn't translated. So I think I also am loving that we're all here on this panel, because I feel like it's these types of conversations that maybe can bring people together to really understand how those pieces fit together and identify kind of what the missing link is, and then move forward.
Well, thank you very much for this wonderful panel. I think that's what we need. We need more conversations of, kind of with different discipline, different expertise to solve this problem. And I'm sure we'll have many more of this. But thank you very much for your attention, and thank you to the panel.
We are going to go right into our next panel, which is going to be hosted by the Center of Global Management here. We're very fortunate to have Roman Warchek, who is the new faculty director of this center, who's going to lead this panel on the economic effects of tariffs.
Okay, everyone, welcome. My name is Roman Vaxiar. I'm a professor here. I'm also the director of our Center for Global Management, and I'm very pleased to convene this panel. The theme is going to be really going from academic research to trying to understand the effects of the Trump tariffs. So as you know, in April, on April 2nd, it would have been ironic to place it on April 1st, President Trump announced Liberation Day, which was a slate of tariffs, at the time largely based on how much of a trade deficit, bilateral trade deficit, the U.S. had with given trading partners. So higher tariffs for countries with which the U.S. had a higher deficit. And then over the subsequent months, there were some adjustments made both upward and downward to these tariffs. And we find now ourselves with the highest level of average tariffs at any time since the 1930s in U.S. history. The average tariff that applies now to our trading partners is about 18%. And so, of course, this is a huge economic disruption, and economists have been wrestling with the issue of how to understand the effects of this massive policy change. And we have on the panel two of the leading experts on understanding the effects of trade restrictions. Pablo Feigelbaum is a professor here at UCLA. UCLA has had a very long and distinguished tradition of having scholars that study international trade. And he is, I would say, at the forefront of this tradition, of the current incarnation of that tradition. He's written numerous papers in leading economic journals about the effects of trade restrictions, both on sort of aggregate variables such as prices and economic growth, but also on distribution, on the unequal effects of trade across the income distribution, but also across space. And so those are some of the themes that I think we're going to approach here. So I want to thank Pablo profusely for agreeing to be here today. And then, of course, Sebastian Edwards needs no introduction. He's the director of the Forecast. Sebastian has had an extremely distinguished career as an international economist. He was the chief economist at the World Bank for Latin America. I think I'm going to stop, Sebastian, and probably the audience knows your bio extremely well. And one thing that Sebastian and I have in common that I think is responsible for why I'm actually here is that we both in the 90s wrote papers about the effects of trade liberalization, and in particular the reduction of tariffs in developing countries on economic growth. And he has a paper, which I think is one of your most cited papers in the Journal of Development Economics on this topic, showing that reductions in tariffs in developing countries have had positive effects on economic growth. And I also wrote, as a graduate student, and then in the early parts of my career, papers on the effects of trade restrictions on growth, again, mostly in the context of developing countries. So you have here, including the moderator, people who have really thought about these issues for a very long time, and hopefully can have some wisdom on the current moment. So I wanted to start with sort of the aggregate question, which is there are speculations on what the effects of the Trump tariffs are going to be on prices and on GDP. And Pablo, you've done work on this. You have in particular a paper that looks at how much pass-through of tariffs is on prices that suggests that the pass-through tends to be very high. So I just wanted to launch the conversation with this aggregate question, and then we'll go into more distributional questions.
Thanks for inviting me to the panel and for the introduction. I don't know, I'm working on. All right. Yeah, thanks for the kind introduction. So let me perhaps set the stage a bit with how we traditionally think about the impacts of tariffs, how textbook economics thinks about it. And we know what tariffs are. You set a tariff and you are buying something from another country. Typically, the entity who pays the tariff is in the US will be an importer that pays the tariff to the US government. Sometimes you hear discussions about who pays the tariff. The key question there is the economic question: who bears the incidence of the tariff? But as a matter of who actually pays, is like an entity in the US paying to the US government. So it's a tax to someone in the US. Then the question there is, obviously, when you pay the tariff, you are going to want to import less, so you're going to buy less stuff from China if you're taxing China. But then the other thing that may happen, other than internal effects on employment, for example, potentially, is that by buying less from China, perhaps Chinese exporters will lower the price of Chinese exports to the US. So in the US, the prices may increase, inclusive of the tariff. So the price that some buyer in the US is the price that China is charging to the US plus the tariff. The tariff inclusive price, that's what we sort of care about as consumers or buyers. But what the US as a country cares about is the price that the US is paying to China. So then economists, when we think about what's the effect of the tariff on a country, on the aggregate country, and that was the question about the aggregate effects, it's always a question about, are we buying more cheaply? And typically the analogy will be here with, like, if you're an entity that has market power, imagine you're a big monopsony or you're a big retail chain. How do you exert your market power? Sometimes you get your suppliers to charge less to you. So then the question is, can the country be better off? It kind of boils down to a question of, is China or whomever is being taxed charging you less for the stuff you pay? So that's the question about for the stuff you buy. So that's a question about pass-through. So that's when we ask about pass-through, is we are asking, is the price going down when you set tariffs? So the papers that Roman was making reference or this is work that was done on the 2018-2020 wave of tariffs. Those were the first wave of Trump tariffs, where many teams of economists, myself included, looked at when the US taxed Chinese goods, what happened with the prices. And there, by and large, the common finding was complete pass-through. Complete pass-through means that we didn't find, wherever we looked, whether China was actually lowering the prices that they were charging to the US. So when we think about the aggregate effects, then we think that it's kind of the US buyer of imports, the one who bears the brunt of these taxes, because it's not that you get to kind of pay less to China. You're paying or the initial price, if you want, plus the tariff, without China lowering the price on the US. So that's one big kind of set of results that we have looked at, and there are many ramifications of that, but that's one headline result, which is like this idea of a complete pass-through to the prices of buyers. Then the other big question, and I will just talk about this and then we can move to other questions, although there are many more things to say, is about the aggregate effects on the economy, on GDP. And here, I guess the takeaways are that the effects were kind of modest, as implied by the standard models that we use. And this is a big caveat because in economics we tend to use a family of models. They are called neoclassical, where all the effects come from these distortions caused by the tariffs. There are obviously many people that have looked at this empirically, that have looked at growth effects and such. But typically, let's do it like a very simple back of the envelope calculation. In 2018, 2020, we had about like a 50% increase on tariffs on China. China was about 15% of US imports, and US imports are about 15% of GDP. This is 15% 3 times to the cube. That's 0.3%. I didn't do it in my head, I remember it. So it's 0.3% of GDP in terms of higher consumer costs. But against that, there is a tariff revenue, which is a benefit, and potentially higher wages. So what we calculated at that time is that it was kind of a wash. So the aggregate effects were not really noticeable. This result kind of triggers a lot of questions. We did see kind of, some people argue that we see big effects on the stock markets and things like that. But the aggregate GDP effects on aggregate income from these tariffs, even though the consumers were taxed, and even though there was some moderate aggregate loss from the Trump tariffs, let's forget about the retaliation for a second, was not very big. Something that may be different this time is that these tariffs are much bigger, so perhaps there are going to be bigger effects. And I'll stop there.
They apply, of course, to a much broader set of countries than just the initial first Trump term tariffs that applied mostly to China, and they were much more selective. And so the calculation you described, you know, I've seen it done on Twitter by Brad Setzer, who's an international economist, and it's sort of referred to as the just pay it tariff. It's sort of multiply the percentage of GDP that is imported with the amount of the tariff, and that kind of gives you the rough estimate of how much GDP you would spend if you just paid the tariff. You know, you just take your GDP and you pay the tariff to the Chinese or to whoever is the tariff levied to. And so those numbers are quite small because imports to GDP are only 15% in the US. And so if you're talking about a 10% tariff on 15% of GDP, that's, relatively small.
Yeah, this time is much bigger. So last time it was like 0.3, and this time the same calculation will give you something like 1.5, which is non-negligible for sure. But this will be like the consumer cost. It's a good back of the envelope for the consumer cost, but offsetting that, there is a potential, wage effects and tariff revenue.
Yeah. So Sebastian, we worked, and you worked, a lot on the dynamic effects of tariffs, and those sort of static effects that Pablo was referring to usually are quite small, but the dynamic effects that people have estimated in the literature, Paul Romer had an early paper on this, on the theory side, and then you and I wrote a series of papers on the dynamic effects of tariffs. They tend to be bigger.
Yes. They tend to be bigger, but as you pointed out earlier, our research was mostly about emerging markets that had 100% tariffs already, that had been piling up through the years when they were pursuing a policy known as import substitution industrialization. So they basically cut themselves off from global trade. And then what we were asking ourselves is, if you had 100% tariff or 200% tariff or straight prohibition to import goods, and you open up to trade, you join the global economy, what would the effects be? And that's a different exercise because of order of magnitudes and the type of countries we're talking about. But what I'd like to do is go back to Liberation Day and tell you a little bit a combination of what was my original reaction and how I think things have progressed And also tell you a little bit about 3 anecdotes that will bring this, I think, a little bit more down to earth. So we have an alum here at UCLA called Ricardo Garcia. Lucy knows him, and he is the CEO of one of the largest salmon producers in Chile. And Chile is the #2 salmon exporter in the world. So this is a very large company. So he is a UCLA grad, and when we take our MBA students to Chile, he always gives a talk and tells us how they are moving forward and so on. And I have also been advising a very large Chinese company, which invested about $2 billion in salmon production in Chile. And both of them tells me that they have eaten the tariff themselves up to now. They have not been able to increase prices of salmon. Although if you go to the supermarket and you buy salmon, it's gone up significantly, about almost 50% since before the pandemic. They say they have reduced their margins. So that's one anecdote, which sort of contradicts what Pablo is saying, although, of course, we cannot conclude a lot of things from one observation. I'm also a very good friend of the CEO and head of the family who owns, you may know this company, it's a wine producer, Concha y Toro, which is a Chilean, it's like a $14 bottle. And if you have a lot of friends coming home, it's not as good as Argentine wine, Pablo. I will, but it's you find it at Trader Joe's everywhere. And these guys also have eaten the tariff. So for now, at least in these 2 areas, the pass-through doesn't seem to be very high. So that's number 1. Number 2, my reaction on Liberation Day was that, and it continues to be the case, although last week it changed a little, it's very unusual, and we never teach it this way, or we didn't teach it this way, at least until I was teaching this, that tariffs are imposed on a country rather than on a product. You want to protect car production in the US. You impose tariffs on cars, but you don't impose a tariff on cars coming from Italy, and you leave the French and the Brits and the Koreans free of the tariffs, because then what you'll have is an adaptation. And what was very unusual about Liberation Day was that it was country by country. And my prediction at the time was this is going to go away, except for geopolitical reasons, but it's going to move towards tariffs by goods. And this is what we saw last week, pharmaceuticals. It doesn't matter where you are. It doesn't matter if the pharmaceutical company is in Israel, in India, in Brazil, in Mexico. Pharmaceuticals, 100% tariff. Furniture. Okay, this is, I think, helping the Carolinas, right? So it doesn't matter if your furniture comes from Costa Rica or comes from Brazil or from Mozambique, it's furniture. So I think that we're going to start moving in that direction, with the exception of the big geopolitical issues, like Brazil, 50% tariff because of the Bolsonaro, Lula fight and so on. Argentina may get 0 tariff because now DJT is a great friend of President Milei. So he may now, I hear today that on October 14th, Milei is coming back to the US and meeting again with President Trump. So he may be rewarded by 0 tariffs. We don't know, the geopolitical aspect. So I think that the question, so let me sum up. I think the question of pass-through, which Pablo has worked and has a wonderful paper on the first round in the first Trump administration. I think now it's still open. It's not going to be 0, the pass-through, but I have doubts that it will be full pass-through as Pablo found during the first round. I think that this means that part of the burden will fall on the producers, producing countries, but we still don't know. And the final thing that I want to say in this first round is going back to the way we teach this, or to undergrads, okay, it's graduate students is a little more common. So what we say is that tariffs affect the price of imports. Now here I want to make a parenthesis. What matters is not the percentage of goods that we import, it's whether the goods that, even those that we produce in the US, are linked to potential imports. Okay, we don't have to import it, but it's just the threat that if we change the price, the imports will come in that links the prices, of course. Okay, but the way we teach this is that imports, if you put tariffs on imports, the price of imports goes up. So the quantity demanded of imports, because they are now more expensive, goes down. So now what you have is, if you had balanced trade to start with, now you have a surplus. And if you have a surplus, what you are going to do, the currency is going to adjust to bring back balance in the external accounts. So the dollar should strengthen in this very basic theory. And in fact, that's what our new member of the Federal Reserve Board, Stephen Myron, wrote in his paper about the Mar-a-Lago Accord, where he said, well, we're going to put tariffs, and the dollar is going to strengthen, and that is going to sort of offset the impact on the tariffs, of the tariffs. Now, what we've seen is that the dollar, instead of strengthening, has weakened very significantly. The dollar-euro rate since January, since Inauguration Day, January 20th, has the euro has become 12% more expensive. 12% is a very large amount, right? So what we are seeing, now there are many other factors, and of course this is, but what we have is that it's related to what Maggie was saying in the environmental panel, or Professor McKinnon. There are a lot of what we call non-linearities, or chaotic effects, and everything is moving in ways that are very difficult to predict. So we have to bring in the dollar, the pass-through, which goods are going to be affected, and finally, something that we did talk a lot about in the I was not around, but the profession talked a lot in the 60s and 70s, is the supply chain effect. And there are lots of unintended consequences, because of course many of the goods, if not most goods, come in as inputs into the supply chain. And if the tariff on the input is higher than the tariff on the final good is going to get negative protection, because the cost of purchasing your inputs is going to go up by more, even if there is full pass-through on the final good, by how much you're going to be able to increase the price of your final good. And I think that in the very simplistic analysis, the U.S. Trade Representative Office completely ignored at first those supply chain effects. Clement today showed us the different levels of production, and I think that we're beginning, or the White House, and beginning to look at those, which are very important, of course.
Just one example of what you're saying, Sebastian. In my global trends class, I show the example of the automobile industry. A car that's produced in the United States, produced in quotation mark, but considered produced in the United States, has 50% of its inputs, of its parts, that are imported. So that caused the GM CEO, Mary Barra, to come out a few years ago during the first Trump administration, I think, against tariffs protecting the auto industry. Because what you end up doing in that case is you might actually hurt the auto industry by raising the cost of their input imports. Shall we move to sort of the distributional effects of tariffs and the unequal effect it might have both across the income distribution and space? Pablo, you've done a lot of work on this. Shall we take these two? Like the first one is on the income distribution. You have a paper that shows that free trade helps mostly poor people because they consume baskets of goods that are most affected by relative price changes brought about by trade relative to trade restrictions.
Yeah, thanks. Yeah, that was initially work that was not about tariffs per se, was more an observation about distributional effects of trade. which if you want is a very simple one, which is lower income households tend to spend relatively more on traded products, and particularly traded products from countries that may have low wages. This compared with richer households, so that typically protectionism and particularly protectionism in higher income countries will tend to, on the distributional side, on consumption, of course, there are all the distributional effects on wages, but on consumption, on the price of the goods that people pay, would typically hurt relatively more lower income households. Now, in the context of the tariffs, an observation here is that, yeah, China has a very broad production and export base, but the expenditures in Chinese goods are more concentrated among lower income households. And if you think about particularly the structure of, like, if you want to talk about the current tariffs, the Liberation Day tariffs, if you look at the extent to which these tariffs, so first, geographically, obviously, they are hitting more China, and lower income people tend to spend relatively more from final consumption Chinese goods. And second, these tariffs are relatively higher related to, Sebastian just talked about the tariffs on inputs and on final goods, but the current tariffs are hitting final goods more than intermediate inputs. So part of the discussion here, or part of the rationale about the tariffs, is supposed to be about reshoring strategic industries or particularly high value-added sectors in the supply chain. But if you look at the distribution of these tariffs across sectors ordered by whether they are final consumption goods or intermediate goods, actually final consumption goods are being hit more. So these things combined, I think, suggest that even the structure of these tariffs, and to some extent the structure of the 2018-2020 tariffs, had a bigger incidence on lower income, or will have a lower incidence on lower income households. In parallel to that, also work I've done recently focuses on the de minimis exemption. So the de minimis exemption was something pretty much unknown to most of us until a few years ago, is this tax loophole whereby until it was just eliminated, you could import up to $800 per day per buyer, free of any tax, mostly. And this is using this loophole was the way that global retailers that you may be familiar with grew over the last years. So something that we have looked at is like the removal of this de minimis exemption. Who is this hitting more? And we also find, and here is direct evidence, that lower income zip codes in the US tend to spend relatively more on these really large international brands that heavily rely on the de minimis exemption. So the removal of the de minimis exemption, the fact that all these cheap things coming, all these items, these packages that were directly shipped to your house below $800, any of them, now are being taxed at these mostly Chinese rates, because many of these are coming from China. This will be hitting the lower income households. So on the consumption side, I think all the pieces of information we had point in the direction of trade being more beneficial for the poor, and the tariffs being more relatively more hurtful for the poor on the on the consumption side. Yeah.
So what's ironic about this is, of course, that the turn to a more protectionist stance in the U.S. is a symbolic of the Republican Party's turn toward trying to earn the votes of blue collar workers more to a greater degree, and so I guess this is in contradiction. This impact of the tariffs is in contradiction with this overall goal. Can you comment on the wage effects then? Should we expect because on the consumption side, people who were traditionally the base of the Democratic Party and have over the decades switched over toward the Republican Party are going to be hurt by these tariffs. But on the wage side, could they be helped? Are we going to get reshoring?
Yeah. So a few things there. So first, if we look at the 2018-2020 tariffs, so the pattern of these tariffs indirectly seemed to help regions in the US that were not extremely Republican or extremely Democrat in terms of how they had voted for Trump. So typically median regions in terms of their political alignment were more protected. It is really when you weight in the retaliation and the Chinese tariffs on US exports, that you find regions that are actually more Republican being particularly hurt. But then in terms of wages, I must say, like the evidence, so first, I think it's too early to tell about wage effects or reshoring effects from this wage of tariffs. I mean, if anything, there is no clear evidence of that. But again, that if there is very clear evidence about trade falling in response to the tariffs, but the wage effects, I mean, there isn't even like enough data to look at this in the way people typically like to look at this, which is using cross-regional variation and different exposure of different regions based on their industrial composition. The research that has been done from the 2018-2020 tariffs points towards kind of modest wage gains in the protected areas that's typically offset by the retaliatory effects from the Chinese tariffs. So in the end, the wage effects are kind of has been slightly positive, not sharply positive. But this is also, we should say that this is kind of a relative effects across regions. There is a question about the aggregate effect on wages. This is not a distributional question, but if we think about are workers better off, this is about wages in the US. And those effects, sorry, I'm coming back to the aggregate questions, relate a bit to these things that Sebastian was discussing. Are we seeing now like a wage appreciation or a wage depreciation? So if you want any sort of smoking gun for these aggregate wage effects, well, the fact that the US exchange rate has depreciated, if anything, is suggesting that we are not seeing these effects, to extent that these are a measure of that.
So let me, not necessarily related to your last question, Romain, but the general issue. A key question, of course, is what is the supply side? So on the demand side, we know prices of imported goods are going to go up, whether it's by the whole tariff or not, we don't know, but they will go up by some. And poorer people tend to consume the goods that are affected the most by tariffs. And if you've taken my class on macro, when we look at the CPI components, we see that, for instance, apparel keeps going down and down and down and down and down. Of course, the lower income families spend more in clothing than the rich. It's also a different kind of clothing. So on the demand side, we know what's going to happen to consumers. On the supply side, as Pablo said, it's too early to know. And a key question is whether these tariffs are here to stay. So if I am thinking of not the mega investments that President Trump talks about, $1 trillion here or there, but if I am producing furniture in North Carolina, and now there is a 50% tariff on furniture, will I expand my operation? Well, I need to know whether this is long-term or if it's going to be undone by the next administration, right? And I think that it's a very complex and very complicated, and it has a lot to do with revenues. That I think we're getting, at least to me, the projections of revenues from the tariffs are much higher than what I thought we were going to get. So we're talking now about $350 billion per year. Now, some of that, as Clement said earlier, may have to be given back if the Supreme Court rules that the Economics Emergency Act is not proper. I don't think that will happen. I think that the Supreme Court will say that it's okay for the administration to use the Emergency Act. But of course, there is this issue of for how long they will stay, the tariffs will stay on, and the income they are producing is very important. If we combine $350 billion from greater revenue from tariffs, from what the Secretary of the Treasury, Scott Bessent, wants, which is to lower interest rates at least to 1/2 of what they are now, we have half of the deficit problem solved. And it goes down from 6% of GDP to 3% of GDP, which is within what is considered to be sustainable. Okay? So there are so many moving parts here where things depend not only on the specific bucket that we're looking at, but on developments in other parts of the economy. Let me just say one more thing that I think it's interesting when we think about this. And I mostly think about this from the point of view of other countries. So I'm called by an Argentine client. I've advised on wine producer, and he's desperate. 10% tariff. This is the original Liberation Day tariff. And I say, listen, the Europeans have 15% tariff, and your wine competes with Italian, Spanish, French, Austrian, and German wine. So yeah, you are worse off, but everyone from the new wines, Australia, New Zealand, Chile, Argentina, and South Africa, they all have 10%. But all these other guys have 15%. So relative to them, you're doing better off. You're doing well. So again, this is just to illustrate how complex this whole issue is. And I am learning a lot, having spent a lifetime working on this and doing research on this. This is a great experiment. Maybe a very costly one, but it's a great experiment.
Another example of what you just said was India and China. The Indians, to whom I talk a lot, some of you, Ruben here and others, were on the immersion trip with me to India. They were very happy about the initial Trump tariffs on China because they thought the substitution would work in their favor, even though they were themselves hit by, I think, 15 higher tariffs. But then this, well, they had always imported oil from Russia. And that's a big aspect of this too, which is the uncertainty over the future path of tariffs, which I think is the big unknown here. The Indians didn't think that they'd be subject to a 50% tariff. Now they're not finding this so amusing anymore. But the initial reaction of the Indian stock market was very positive to the Liberation Day tariffs because they were, as you said, relatively advantaged relative to some of their competitors. But that's changed now. We're running out of time. Should we take a minute to should we take a question? Yeah. Let's take one or two questions.
Let's take two questions and we answer and then we answer.
Okay.
I just felt so unsatisfied. I'm not an economist and I don't play one on TV, but full pass through and then maybe not. It just feels difficult and time will tell. I did have a question on the difference between looking at an industry that may have marginal profitability high enough to take the tariff and still be in business versus an industry where it would put the whole business upside down with the notion of their price, takers and makers. I get that versus a total economy. So is there a difference when you talk about salmon and wine and Professor Begelbaum is talking about the overall flows from country level?
Can we take one more? Two questions. This one. You run. You have one question. Okay, let's take the two questions and then we'll answer.
We'll conclude by answering them.
We combine the answer.
Should I ask it now or should we?
No.
Okay, well, so I'm just curious. So if tariffs are increasingly being designed as a country by country basis, does that shift them from being primarily an economic tool to being more of a geopolitical one? And does that affect how economists think about them?
So let me try to, and then we'll go to Pablo, who knows more about all of this than I do. Yeah, so this is what I intimated. It's turned into a geopolitical issue, and what happens there is that there is substitution, and there may be problems with rules of origin. So think of South America. Okay, so the president of Chile went to the UN, and he spoke. Not the next one, but the next after the next after the next after President Trump, and called Trump a liar. He tells lies without mentioning him. But he basically said the president of the United States is a liar. So let's assume that Trump gets unhappy and imposes a higher tariff on Chile. Chile is the #1 producer of copper in the world. Peru is the #2 producer of copper in the world. So most of copper importers are going to import from Peru rather than from Chile. And many Chilean firms, smaller, not maybe the BHPs of the world, because they are, but or Rio Tinto, which own large mines, are going to pretend that their copper comes from Peru, from Chancay, rather than from where it comes. So it's a real mess, and it's a completely different. We have the tools to deal with that, but it's not the traditional way of doing it. So why? Because the traditional way is if you want to protect the copper industry in the U.S., say in Arizona, you put a tariff on copper independently of where it comes from. And to your question, yeah, the aggregate is the sum of the parts, but there are always aggregation fallacies. It's not a simple sum of the parts. And I think that this is such a messy experiment with so many moving parts that there's nothing wrong with saying we don't know yet what will happen, right? And now, and I'll finish with this. Many of the people who talked today talked about the problem with uncertainty and unknowns. At least these are known unknowns. The problem, as famously was said by the Secretary of Defense, the problem with the unknowns, and I think that all of these or most of these are known unknowns. And if we do good research as it's done here at UCLA, and Pablo and Roman are leading the charge on great research, we are going to know more about what today are unknown unknowns.
Another aspect, if I can interject on this question, is the horizon at which the prices adjust. So it's very early still from Liberation Day to see perhaps full pass-through, but Pablo, maybe you can say about this. It's a longer-term process.
Yeah. So
how long can you absorb losses, you know?
Yeah, coming back to that, the one thing I would say again about pass-through is like, so far, actually, what we have seen, and we are working with my co-author in sort of redoing all the analysis we did for 2018, 2020 for the current tariffs, is the event studies are looking surprisingly similar, meaning at the gate, when we look at the import prices. So first, the trade, and this is a study that differentially, we are basically looking at the commodity and how much you import of that commodity from China that was taxed versus another origin that wasn't. So we see like a similarly sharp, if not more, decline in imports for a given increase in tariffs, and we are not seeing these anecdotes notwithstanding reduction in prices at the gate. And of course, there is a lot of heterogeneity, and some of these stories may be, well, these are industries that have different degrees of pass-through because of market power and such. The one thing that I think is intriguing and that we are going to learn more is that this is at the gate. This is the prices that the US is paying to China. But people who have been looking at the prices at stores, and there have been some researchers at Harvard that have been looking at this, just looking in real time at the prices at like large retail chains, those effects are very muted, actually. So if any, so in this story, like the first approximation to this really bold, like if I wanted to make like a very bold statement with like very preliminary data, I would say it looks like we are not seeing so far clearly lower import prices. And again, the exchange rate is if anything, appreciating, but we are not seeing the prices really falling, increasing yet at the store. So if anything, is the kind of the intermediaries that are absorbing the incidence within the US, but not yet the consumer from this preliminary evidence. Yeah.
But it could change.
Yeah.
Well, I want to thank the panelists. I think we're out of time. And there's lunch, I think. So thank you both.
Thank you, Roman.
Thank you.
That was good.
Thank you, Roman. Hello. Hey. Thank you, Roman, so much for that wonderful panel. This ends our agenda for today. I want to thank you all for attending, our wonderful panelists and speakers. I also want to thank our sponsors one more time. We are a public institution and we could not do this without our sponsors. So at the principal level, we have RSM and Yamava Resort Casino at Sunwell. At platinum level, we have the law firm of Allen Malkins, California Bank and Trust, Cathay Bank, Clark Construction, Mercury Insurance, and University Credit Union. At the gold level, we have Alaska Airlines, Bank of California, California Steel Industries, Hub International, Leap Development, Numo, PNC Bank, Robert Half, SMBC Manu Bank. And at the silver level, we have Slalom, US Bank Private Wealth Management, and Wilmington Trusts. And finally, at the bronze level, we have Active Security, Hanmi Bank, HCR, the Port of Long Beach, and Shawmut Design and Construction. So again, thank you very much.
If you do not see your name up there, we can fix that. So please come and see us.